to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Equity futures right now on the S&P still just about positive, up by close to 0.1%. We're 2 hours away until the cash open with your morning movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Las Vegas had something for everybody, from the jacket that Jensen Huang wore through to the sprinkling and the halo effect in terms of the companies that he's doing business with. The stock was up aggressively so far this year, up 11%, and it's the scale of adoption of Blackwell. Blackwell and Engine AI has arrived for PC gamers, developers, and creatives. This was about talking about robots, a business worth $38 billion is the projection. Hardware, $3,000 hardware PC for AI developers out there. So this is about encroaching more into autos, more into robotics, and really there was a sprinkling of dust for everybody. Uber got a little bit of the halo effect because yesterday, 24 hours ago, I was talking to you about the upbeat guidance from Uber along with the buyback. NVIDIA and Uber. The data from Uber will lock into NVIDIA and give you the road forward, as Dara Khosrowshahi says, to supercharge the timeline for safe and scalable autonomous driving. So there really was a drop the mic moment for a number of different companies. Let's run it off with Tesla. It's interesting, they're on the back foot this morning. Bank of America downgrades the stock. Why? Because it's a valuation and execution risk. They do shift the price target to $490 from $400, since that's a genuflection to the valuation. But robotaxi now accounts for over 50% of the implied valuation in this stock. And therein lies the point. Where is the future of autonomous driving? How much of Tesla is really about the cars? We've talked about this with Dan Ives. That's about 15, 20%. The rest is on autonomous driving and the AI trade. So for now, the Bank of America just takes 2% out of Tesla in the first wave this morning. Jonathan.
Manus Cranny, thank you, sir. Appreciate the update. We'll touch base again in about 60 minutes' time. And the surveillance this morning, US East Coast dock workers and their union meeting today to try to negotiate a new labour deal. If they don't come to an agreement, a January 15th strike that would shut up major East and Gulf Coast ports is all but certain.
So, new year, same problem, and potentially you could have 47,000 workers at these major ports striking as soon as next week. Interesting, though, early October, the International Longshoremen's Association got backing from high-profile backing, at the end of last year in December, from President-elect Donald Trump. And he almost was taking their side when it comes to automation. And at the end of the day, that is what this fight is about.
That's what I want to build on, the idea of semi-automated cranes, the use of them. And basically they're saying if you use them, you have to have extra workers on hand. And companies, dock operators are basically saying, look, you can't tie our hands in terms of efficiency before we even get started and understand what the technology is. This is going to be a fight that's going to be increasingly difficult for leadership to really weigh in on, given the hope economically for a whole much more productivity.
I'd also throw this in there, not just what the tech is, but where the tech is coming from as well.
That's a great point.
Been a major issue regarding the next story as well. Treasury Secretary Janet Yellen telling the Chinese Vice Premier that recent hacks of the Treasury Department raise, quote, serious concern about malicious cyber activity. Yellen also warning of consequences for Chinese companies that support Russia's invasion of Ukraine.
So we've heard this before, and I go back to that story with the incredible detail over the weekend that we've spoken about, this Wall Street Journal story, and their sources were saying how Jake Sullivan told these telecom companies in the fall of 2023 about China just lingering and hacking. What I found so interesting when I saw the press release, though, yesterday from Treasury, it was the last line. Yellen expressed serious concern about malicious cyber activity to He Fang. The last line. And after everything we've learned about what China is doing, their pervasiveness across U.S. industries, hacking her and her colleagues' potentially emails, and also listening in on conversations of President-elect Trump, you'd have to think, why didn't they lead with this?
Well, Janet Yellen has been a huge proponent of bilateral conversations and the importance of maintaining communication as a way to avoid some serious altercation. This is probably her last communication with her counterpart over in China, and it raises the question, has it been effective, especially when we're talking about these malicious hacks that are still being unfolded?
Pretty shocking reports. The latest on the United States and China. Let's finish on this story here. Meta revamping the company's approach to free speech. The CEO, Mark Zuckerberg, saying Meta will drop its third-party fact-checking and move to community notes similar to X. Meta will also lift restrictions on some topics and take a more personalized approach to political content in the United States.
It really just feels like this is yet another company that is shifting to the right, reading the tone of the room of the electorate of the United States. Many people you talk to say they feel like corporate America has gone to left. Meta now, Nick Clegg is out, Joel Kaplan will be running the scene, and I think adding Dana White, I think really tells you the tone and the tenor potentially we could see out of Meta.
There's also a larger question here about, A, where the liability lies, right? They don't want to have the liability of a news organization, so they want to step away from that. But number two, what the role is of some of these social media companies and whether this is actually just removing politics or whether this is just injecting a new form of politics on different types of businesses remains to be seen. Social media still needs to be worked out in terms of the main way a lot of people get their news and, frankly, what kind of filters people are. Look, we all hope it becomes the town square where everybody can actually voice honestly their opinions. Let's hope that this moves more toward that.
Meta's down in the pre-market by about 0.6%. Not a big move. Plenty more updates on that story a little bit later. Let's turn to the Federal Reserve. Investors are waiting December Fed minutes and more Fed speak this week. Jason Thomas of Carlyle saying, though policymakers keep using the word restrictive, it may not mean what they think it means. It may be time for the Fed to leave well enough alone and retire the presumption that this economy cannot withstand rates at these levels. Jason joins us now for more. Jason, welcome to the program, sir. Let's talk about that word restrictive. What guides your view about how restrictive we actually are?
Well, if you look at the last 18 months, the real Fed funds rate has been in excess of 2%. That should be very restrictive. But yet over that same horizon, we've had real GDP growth that's averaged nearly 3%, almost twice the level most forecasters had for the U.S.'s potential growth. We've had productivity growth that's exceeded 2% on an annual basis for the last 5 quarters. And of course, we're left with core CPI that is still above 3% when you add in measures of financial conditions, stock valuation ratios, credit spreads at 17-year tights. I don't see restrictiveness anywhere one would look in the data. And I think it's time to retire this language because in many ways it's also created some damage because it's created expectations among market participants, among investors, management teams, that they should delay transactions, delay interest-sensitive purchases 6 months, 12 months, 18 months into the future when rates are lower. So I think just abandoning this language, changing the rhetoric, accepting that it looks to we're more or less at neutral today would actually be, I think, quite helpful in terms of many of the elements of the economy coming to terms with rates likely persist near these levels.
Jason, what do you see the message as from the long end of the yield curve, the idea that as the Fed has cut by 100 basis points, the long end of the yield curve has risen by 100 basis points?
I think it's the market repricing neutral. The term premium is estimated, right? It is the 10-year yield in relation to expectations for short-term rates over those 10 years. What are those expectations? I think that right now, it's not so unreasonable to think 4.25 is going to be where the Fed funds averages over this 10-year period? If so, 10-year yields at 460, that's not really much of a term premium, at least when we look historically. The term premium in the 90s averaged about 150 basis points. So I think that we've been so used to during the period of QE, during the very large reserve accumulations, China, other central banks, we became accustomed to a term premium that was zero or negative. And so a term premium that's modestly positive, people think, oh boy, this is a sign of concerns about the fiscal outlook or just the sheer volume of bond offerings. But I think a much simpler explanation is that the neutral rate has just been repriced by markets and it's moved into the 4.25 range.
Jason, when you look out over 2025, you just put out a paper talking about some of the big questions for the year ahead. If you look at just where the market is setting up, the market seems to be positioned for U.S. exceptionalism, tariffs that are going to affect the rest of the world, not necessarily the United States in a negative way, and the idea that we're going to get a soft landing with a few more Fed rate cuts at the same time as technology really does increase efficiency across the sphere. Where would you push back against that market positioning?
Well, I think first, we have to wait and see what Europe is going to do in response to the U.S. election result. 14 months before the U.S. election, European Commission President von der Leyen commissioned a report from ECB President Draghi. And we'll see if they act on it. People talk about Europe's security dependence on the United States. But over the last few years, there's been an increased economic dependence. European exports to the United States are up 52% since 2001. Over the same period, European exports to China have basically flatlined, largely because of the sudden emergence of China's auto sector. So I think I would pay very close attention to changes in Europe. It's priced about a 40% discount to the United States. Obviously, market participants are not especially optimistic about the likely changes there. But that provides a pretty significant risk compensation to investors. Secondly, I think most people are focused on NVIDIA, AI. I think we should increasingly focus on NVIDIA's customers. The four largest customers in the United States their capital budgets roughly doubled from 2023 relative to intended investment in 2025. Data center investment in the United States up 8-fold over this period. We're going to see how productive these quote-unquote AI factories are. And I think that this is going to have a big impact because the valuations of these companies are implying that the return on this capital is going to be in a 25-30% range. And we're waiting for the proof in the pudding. We don't yet see clear evidence that there's going to be the downstream revenues and applications necessary to justify all those outlays.
Are you basically saying, Jason, that you're bullish right now on Europe and getting a little bit more bearish on U.S. big tech?
I think that, in the past, big tech in the United States had enormous price-to-book ratios, the valuations, because, you don't value a money printing machine based on the cost of the paper or the printing press. So they were very rich in intangible assets. Over the last few years, what you've seen, I think, is effectively a change in strategy and a move to a much more asset-heavy business model. If you look again at just the top four customers in NVIDIA, their capital budgets have gone from just 0.1% of U.S. GDP to now over 0.7% of 1%. So 0.7% of U.S. GDP. I mean, this is really phenomenal increase in spending, and the valuations have actually increased over this period of time. Price-to-book ratios have actually gone up even as they've moved to an asset-heavier business model. So again, this is interesting. It's certainly curious, and I think when you look at what is cheap, what is not at risk of a valuation decline related to, again, rates being higher for longer or just a revision to growth expectations, I think much of the rest of the world, but especially Europe, you are getting pretty well compensated. And also, I would say that, the euro, I think it's reasonable to expect that it is going to break through parity by June. So, by the second or third quarter of this year, you could have, if you're a U.S. dollar investor, you could be looking at a European market that looks exceptionally cheap, both in terms of the valuations, but then also on a currency-adjusted basis.
Jason, are you almost saying at the end of the day, an antagonist approach from an incoming Trump administration might force the Europe to actually find its own growth and be a great place for investment?
And we'll see what they do, but the issue in Europe is not the lack of tools, the lack of resources. Europe saves more than the United States in terms of just raw financial resources. They have more than the United States. It's been a lack of political will. And it's also been an assumption, and Draghi calls this out in his report, that actually the inaction is the only way to preserve consensus. Well, inaction is actually deepening political divides in Europe. So we'll see. Of course, we have a German federal election in February. We'll see, what that signals about the electorate's appetite for change. But I think perhaps even more importantly, it could signal to policymakers the sorts of changes that could be in store if they don't reform. So yes, I think that this Trump election victory could be a very important impetus for changes that in many ways are long overdue.
Jason, appreciate your time. Really thoughtful stuff, sir. It's good to hear from you. Jason Thomas there of Carlyle, particularly on Europe at the end. Europe's issues are so deeply, deeply cultural that it's going to take a lot more to get them out of this hole.
Does it take much, though? If it doesn't take that much, if it just is a slight upside surprise or a slight sense that there could be leadership, Jason's point is it doesn't take that much based on where it's priced.
Saw evidence of that in the last 24 hours in foreign exchange, the point we've made on this show a few times. Euro dollar right now just short of 104, 103.95. With an update on stories elsewhere this morning with your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. Meta is revamping the company's approach to free speech. CEO Mark Zuckerberg says Meta will drop its third-party fact-checking and move to community notes similar to X.
After Trump first got elected in 2016, the legacy media wrote nonstop about how misinformation was a threat to democracy. We tried in good faith to address those concerns without becoming the arbiters of truth. But the fact-checkers have just been too politically biased and have destroyed more trust than they've created, especially in the US. So over the next couple of months, we're going to phase in a more comprehensive community notes system.
Meta will also lift restrictions on some topics and take a more personalized approach to political content in the U.S. Dell, meanwhile, is rebranding its PC product lines in a bid to revive weak sales. It dropped decades-old names like Inspiron and XPS in favor of simplified Dell, Dell Pro, and Dell Pro Max lines. AMD said Dell will use its chips for some of its business computers for the first time, a blow to rival Intel. President-elect Donald Trump has reiterated his ambition to buy Greenland as his son, Donald Trump Jr., prepares to visit the Arctic island. Trump promised to make Greenland great again after news of his son's visit emerged late on Monday. Trump wrote on Truth Social, Greenland is an incredible place, and the people will benefit tremendously if and when it becomes part of our nation. We will protect it and cherish it from a very vicious outside world. That's your Bloomberg Brief. John.
Danny, thank you. Watch this space. Up next on the program, the case for higher for longer.
They understand that the economy is doing okay. Inflation is a little bit sticky. So it makes sense to wait. We're going from a period of low uncertainty to much higher uncertainty, and that's what's got to get priced into markets.
Up next on the program, we'll catch up the former Chicago Fed President Charles Evans from New York. You're watching Bloomberg TV.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
You're spoken, sorry.
My voice and my conversation, my poetry, you know.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Stocks up for two straight sessions. We're up again this morning by close to 0.2% on the S&P. Bond yield's a little bit higher as well. Some headlines in the bond market in the last 24 hours. The 30-year yield, the highest since 2023. In the US and the UK, the highest since 1998. Just unbelievable. Under surveillance this morning, the case for higher for longer.
They understand that the economy is doing okay. Inflation is a little bit sticky, so it makes sense to wait. They also understand that there's a lot of uncertainty about what policy is going to be forthcoming. And Powell said when things are uncertain, you should slow down. So I think that all makes a lot of sense. I think the big disconnect, I think, between markets and the Fed is where is the Fed heading over the medium to longer term? We're going from a period of low uncertainty to much higher uncertainty. That's what's got to get priced into markets.
So here's the latest this morning. Fed Governor Lisa Cook saying the FOMC can proceed cautiously on further rate cuts with inflation pressures remaining. The former Chicago Fed President Charles Evans writing, I expect inflation will return to 2% within the Fed's current timetable. They don't want to risk cutting rates and then need to backtrack higher if inflation rises again. Charles joins us now for more. Charles, welcome to the program, sir. Just want to go through a range of comments we've had from Fed officials over the past few days. Governor Cook said inflation has been stickier. Governor Kugler said, obviously, our job is not done. President Daley said we're uncomfortably above our target. Why do you suppose, with all of that in mind, they reduced interest rates at the last meeting?
Well, I think that, the Fed has done a readjustment in the stance of monetary policy. They've cut rates by 100 basis points over the last year, since September. And the last cut in December was a close call, according to Chair Powell. So I think they're well positioned at this point to deal with the risks that they expect to be facing this year. And I think there are an awful lot of risks. Inflation has been bumpy, and their focus is on getting inflation back to 2%. They are looking at a projection themselves of core PCE at the end of this year at 2.5%. That's a little bit more than uncomfortably above 2%. And they don't give any indication that they're willing to sort of say, well, 2.5 is really not that far above 2%. So with their focus on 2%, I believe the Fed policymakers that they are going to be patient in adjusting monetary policy, and they're going to need to see improvements in inflation.
How concerning is it to you that longer-term rates have risen so much since the Fed finished cutting by 100 basis points last year?
There are a lot of things going on at the same time, and so it is the case that the Fed funds rate is lower. That would put downward pressure on the 10-year rate for sure. But it's also the case that their fiscal deficits are continuing to be high. There's a lot of uncertainty about that. How are investors going to be responding to that? And so I think it's natural to suspect that Funding rates could be higher at the long end. It's also the case, that productivity is higher. AI offers a lot of promise. Growth has been above 2%. Our assessments of long-run trend tend to be about 2%, but if they're higher, that would also justify higher long-term rates too. So there are many things in play, plus all of the uncertainty associated with volatility and tariff commentary.
How much are you concerned about the fact that the Fed hasn't really put out a framework for how they're going to deal with some of the potential policy changes that are coming out? This was something that former New York Fed President Bill Dudley was talking about. Do you think there needs to be a better communication of scenario analysis around tariffs and around potential immigration changes?
The Fed communications is always difficult. It's difficult for central banks. It's difficult for any institution that is dealing with uncertainty and talking about what they're going to be doing over the next 6 to 18 months. Uncertainty is just very difficult to describe in a way that many readers can fully appreciate. The Fed has a number of communications tools. The summary of economic projections are one of them. And so, by the Fed's own take, they've indicated that they're expecting inflation is going to be higher than they previously thought for longer, and they need to take action. You could go through a few different scenarios where, well, it could be better than that, and explain how, the funds rate would fall. Or you could say it's going to be worse than that. They have internal documents where they go through that. I'm not convinced that the public would be able to digest 3 scenarios when they have as much difficulty with one. You'd constantly be going, well, which of the 3 do you really think we should be paying attention to?
Speaker Johnson is talking about this potential one big reconciliation bill by May. If that is the case, does the Fed then just stay on the sideline and wait for the policy chatter to become actual legislation?
Well, I think the typical Fed approach, Chair Powell has tried to describe this at the last couple of press conferences, which is to, observe the legislative process, observe the progress. When do they get legislative language? When is it about to actually take, it be enacted, and what actually ends up in the bill? A lot of things end up, at the last minute in a bill or get taken out. And so it's very difficult to have confidence that you know exactly what the stance of fiscal policy is until you get real language there. And I mean, if you just go back, previously when you've talked about eliminating the Affordable Care Act, that would have huge implications for the economy, and it came down to a single vote. And so, you have to actually go through the process before you can fully appreciate what that's going to do to the economy. That's part of the uncertainty that I was talking about. Right up until the end, it could go either way sometimes when it's a coin flip, with very large implications for the path of the economy.
You've lived it. We appreciate your experience, sir. Former Chicago Fed President Charles Evans on the latest effort from the Federal Reserve, a Fed that seems to be swinging between 2 risks. One risk being cutting too soon, too much too soon, and another risk being too restrictive for too long. And I'm not sure they know where they are.
And that's the reason why we're going to hear a lot of patience. The question is, what exactly does patience mean?
Coming up in the third hour of Bloomberg Surveillance, we'll catch up with Omar Aguilar of Schwab Asset Management, Dan Niles of Niles Investment Management, Dana Peterson of the Conference Board, and Brian Weinstein of Morgan Stanley. From New York, you're watching Bloomberg TV.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings, and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that is.
I'd be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Market, I think, is more focused on the near-term effects of tariffs.
The markets will cheer a narrower approach to tariffs.
Markets have been sort of underestimating how much the Trump administration likes tariffs as more than deal-making.
I don't think any of us know. I'm not even sure the administration knows what the final set of tariffs are going to look like.
We're still in this waiting game. Things are proposals right now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It is January 7th, and it already feels like things are getting a little bit too breathless. Not even had an inauguration yet. That's on January 20th. Still got to go at the payrolls report on January 10th. Once you've got all that, still need to figure out the direction for policy, for tariffs, for how big this one big beautiful bill is actually going to be, and whether it will be one big beautiful bill or whether it will be two. There's a lot of things we've got to figure out.
You said it feels breathless. Well, let's see if anyone can catch their breath. I think that yesterday was a perfect example of that, the whipsaw of headlines coming out. It's going to be pared back tariffs. No, it's not. What are you talking about from Donald Trump? The moves in the market highlight a couple of things. How offsides into how crowded trades people are, long dollar U.S. exceptionalism, and the question of what it takes to truly disrupt that.
Also, this won't be an administration that's like watching paint dry. President-elect Donald Trump is going to want to maneuver, and he's going to want optionality, which means there is going to be a lot of whipsawing. But Jonathan, to your point about this optionality of one or two bills, potentially by Friday, we're going to have two bills because he's going to Washington, D.C. tomorrow. He's going to meet with Senate Republicans. And guess what? They want a two-path approach to enact his agenda. Very different than, well, the congressman is going to meet over the weekend. So then on Monday, we're going to have a different narrative. And that is what we have to get used to.
The backdrop for financial markets is just absolutely amazing at the moment. We've got long-end yields at levels we haven't seen for a number of years, since 23. for the 30-year in America since 1998 for the 30-year in the UK, and questions about how much fiscal space we actually have in 2025 for various governments at a time we're seeing big changes to political leadership too. And these are all things investors have got to think about.
Especially given the fact that you've got a lot of debt issuance on all sides of the Atlantic, right? I mean, this is sort of the point about how much fiscal space. You talk about that with the United States, with the auctions this week, and just going throughout the year as the deficit does deepen, but also in the UK. And questionably and arguably, they have that much less fiscal space with those debt auctions, maybe spurring this rise that you're talking about to the highest levels on those yields and long-end yields in the UK going back to 1998. A question here about whether this is noise or whether this is signal for the path ahead at a time when some people are saying, as we just heard Charlie Evans say, formerly of the Chicago Fed, inflation still is on a path to 2%.
I'm getting some signals from corporate America. These aren't just questions for the government, they're questions for companies as well, worldwide. Brings up Meta. If you're just joining us, welcome to the program. About 60 minutes ago, we heard this from Facebook. Starting in the United States, we're ending our third-party fact-checking program and moving to a community notes model. We will allow more speech by lifting restrictions on some topics that are part of a mainstream discourse. The latest from Mark Zuckerberg and company.
And that comes after a number of personnel changes at Meta, decisively moving to the right, whether it's Dana White being put on the board, or whether now Nick Clegg is out and Joel Kaplan will be the head of global policy at the company. And this is just an additional company that's moving away from some of the left approaches we've seen at corporate America. Walmart came out yesterday. At the end of the year, we heard from the likes of Boeing and John Deere. Jonathan, you always say this, and I thought about this yesterday when I saw these moves, what Michael Jordan would say, which is that Republicans buy sneakers too.
All I can say is that this is also a bit of a kowtow to Elon Musk, that we're moving to the same model that Elon Musk has. And when you take a look at all of the potential people coming into the new administration tied to technology oversight, all of them are friends or connected to Elon Musk in some capacity. So you have to wonder how much this is an effort on that front as well.
Right, it's the PayPal mafia. You landed it nail on the head. Those are the individuals that they're either talking to behind the scenes or that are getting seats at the table. What is interesting, though, is you hear a lot of people saying that there's been a shift too much to the left in corporate America during the last 4 years. Will they make the same mistake, though, and go too far to the right, instead of what, Jonathan, you said earlier, and what French Hill said, the congressman of Arkansas, of just getting politics altogether out of the C-suite?
Or are we just replacing it with a different kind of politics? I think back to earlier this year, after the assassination attempt on Donald Trump's life, and the conversation that we had with Mark Zuckerberg, Emily Chang sitting down with Zuckerberg. And I think that was the moment, at least around that time, where you really got a sense that Mark Zuckerberg had woken up to the reality that we were about to get a second term from President Trump. It turned around to Emily and called it badass, one of the most badass things he's ever seen. And since then, you've just seen a series of changes come from Mark and the company.
Mark and the company, as well as, and he was one of those individuals that went down and had dinner with President-elect Trump at Mar-a-Lago. But not only that, Jeff Bezos, another individual that was seeing the change of tone. He's tweeted 3 times this entire year. 2 of them were about Trump, and 1 was denying a report about a $600 million wedding.
It's a big change. Equity futures right now on the S&P positive by 0.1%. Coming up this hour, we'll catch up with Omar Aguilar of Schwab Asset Management as stocks notch back-to-back winning days. Dan Niles of Niles Investment Management as the Max 7 returns to market dominance. And Dana Peterson of the Conference Board counting down to payrolls Friday. We begin this hour with stocks higher as the AI frenzy once again takes center stage to start the year. Omar Aguilar of Schwab Asset Management looking for rotation. Themes such as the broadening of earnings growth beyond tech and mega caps and the potential resurgence of small and mid-cap companies may present compelling opportunities for investors. Omar joins us now for more. Omar, welcome back to the program, sir. A lot of people said the same thing, and then December happened. What went wrong?
Well, I don't think. Good morning and happy New Year to everybody. And I don't think anything went wrong in December. I think it was a very natural reduction of risk and repositioning going into next year. We had an amazing, 2024 where a lot of things went right. And I think the investors just took a little breather just in preparation for what is, going to be a very interesting 2025. When you think about just the level of small, negative returns that we had relative to the entire year, when you put all the pieces together, the S&P and most of equity markets, ended ended up having a pretty consistent performance for 2024. I think what is interesting going into this year is this rotation that is mostly driven by, how momentum is shifting. It is sort of what is compelling, and these levels of volatility that we have observed so early in the last couple of days that have, still, trying to see which one of these sectors will lead the way is probably the most interesting part we're going to see in the first quarter.
Well, Omar, we know what's led the way over the last 12 months. Big cap tech absolutely dominated. Is there anything to believe that's going to change in the quarters to come?
Well, if you just look at the top 20% of the what is called the momentum stocks, those have outperformed the market by around 20% on a cap weighted basis. And as you said, most of that has been dominated by the top 7 or the top 10 AI tech related companies. What we have observed over the last 3 months is that top 20% of momentum is now starting to just be a little broader, where there's financials, there's media, there's entertainment, there's other companies that have inched their way into that top quintile of momentum, which also is consistent with what we've seen in the interest rate cycle and the macro environment. So what we have observed here is that now we're going through, the discussion that we had for the entire 2024 about what kind of landing we had, whether it's going to be a hard landing, a soft landing, whether it's going to be a recession. That seems to be just old news. And now we're going into this process where, everything seems to be pointing towards that the recovery. What leads the recovery tends to be cyclicals, tend to be small cap, tend to be, part of the process that we already seen, at the beginning of this year.
At the same time, Omar, you are neutral in duration. This isn't necessarily a rates call. So you think that the cyclical area can actually rally and overperform even in a rate situation that doesn't change that much from where we are. Is that correct?
Yeah, well, this is an interesting piece. What I was discussing earlier, it's obviously relative to what I consider to be a more orderly positioning of equities. I think fixed income and bonds are still in a very wide range of possible outcomes. And I think we're preparing ourselves for another year of a lot of uncertainty and a lot of volatility in yields as we go in through this year. We're already seeing that increase in the long-term yields, in the first few sessions of this year. We've seen that the yield curve is clearly steepening, and it's steepening pretty fast. And a lot of that is as a result of inflation expectations, is economic growth, and also just the term premium continue to just be, pretty high. When you put all the pieces together, the potential range of outcomes within, the fixed income, it is pretty high. So I would probably say that the reason why we continue to emphasize to our clients to just try to stay neutral to their duration is because it's very unclear, where this thing is going to go. And I think it's going to take probably a few more data points and a few more decisions by the Fed to figure out where the yield environment will take us.
Given that backdrop, Omar, we were speaking with Torsten Slok earlier, who said there is this concern we could see a repeat of what happened in 2022 when both bonds and stocks sold off. In this type of environment, what does diversification look like?
Yeah, it's interesting because that is, a discussion we have had, not just recently, but even in the last, quarter of 2024, where, the concern is with good performance on equities and all of a sudden with the uncertainty in yields, is there a possibility where things will just need to be, different? There's two things. One is, the concept of what we have on the short end of the curve. So what is being cash or cash equivalents, that seems to be extremely, positive and a very good foundation for what comes ahead. So it is a different environment what we have in 2022, where the prospect of, where the short-term part of the curve was going to be was very different than what it is now. We're seeing in the process where we know the potential path for the Fed, maybe the speed of where, how many cuts we're going to have and how many, how fast they're going to go in 2025 is still unclear. But we know that at least the short part of the curve is going to be contained in a place where it is going to have a good foundation for the rest of the market. Now, when we actually see about the correlation, and we do a lot of work in terms of just correlation of asset classes that have been, very consistent in the way that we had, over the entire history, where we have the negative correlation you expect between fixed income and equities that seems to be pretty healthy. Back in 2022, if you recall, at the beginning of 2022, both equities and fixed income were expensive. What we're actually seeing right now is the relative valuation and the equity risk premium seems to be, in a place where we still still think that equities tend to have a little bit of an edge, but the correlation structure seems to be working the way that investors, should use for diversification. That being said, we're always encouraging, clients to look for other sources of diversification, especially, as they look in potential alternatives and any other asset classes that can give them a little extra, diversification.
It's why the likes of Bitcoin has done so well over the last year. Omar, it's good to hear from you, sir. Omar Aguilar of Schwab Asset Management. That last note on bonds, an important note. This is something that Mike Wilson and the team over at Morgan Stanley have been reflecting on. The decisive negative correlation between what's happening with bond yields and what's happened with stocks. Bond yields up and stocks down. I think there's a reason for that. It's the why yields are going up that's starting to get onto people's nerves, I think, just a little bit more. Mike Wilson pointing out that economic surprise indices have fallen and thus are not the driver of high yield. So this is not about economic data. Maybe it speaks to those deficit concerns just on the margin, just a little bit more.
This is the dark matter point that Neil Kashkari has talked about, the term premium, which raises the question of, is this because of concerns around the deficit? Is this concerns about just inflation remaining too sticky? It doesn't seem to be stemming right now from increasing growth expectations.
Mike Wilson joining us tomorrow morning, 7 a.m. Eastern Time, so don't miss them. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden is establishing 2 new national monuments in California, protecting 848,000 acres of land. The proclamations creating the Chuckwalla National Monument and the Satitla Highlands National Monument mark another initiative to establish his legacy. According to the White House, both new national monuments only reserve federal territory, not state or private lands. McDonald's is no longer setting aspirational representation goals, a revamp of its approach to diversity, equity, and inclusion policy. The company is retiring its DEI pledge in its supply chain, renaming its diversity team as the Global Inclusion Team. McDonald's cited the evolving landscape around DEI in the U.S. as a factor in its decision. And prices for used timepieces fell last year, with the Bloomberg Subdial Watch Index at its lowest since 2021. Popular Rolex models dropped 5%, Patek Philippe dropped 4%, and Audemars Piguet lost about 7.5%. Cartier is the only brand whose individual index has posted gains since January of 2023. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes. Up next on the program, The Morning Calls Plus, Dan Niles of Niles Investment Management on the changes coming to Meta and a whole lot more. Looking forward to this with Dan in just a moment.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Stocks up again this morning, positive by 0.2% on the S&P, building on 2 days of gains on the benchmark in America. Let's get you some morning calls. First up, UBS upgrading Bank of America to buy, saying it's an overlooked winner of 2025 and is set to benefit from a capital markets resurgence. That stock is up by 1.3%. Your second call from Nathanson downgrading Apple to sell, citing high valuation, antitrust overhang, and a weakening position in China. That stock is down 1%. And finally, Bank of America downgrading Tesla to neutral, warning of execution risk and saying upside drivers are already priced in. It's a rare downgrade. A stock is down in the pre-market by 1.7%. Let's stick with tech. Meta, revamping the company's approach to free speech. The CEO, Mark Zuckerberg, announcing a number of changes, including the removal of third-party fact-checking and a move to community nodes. That's very similar to what we see on X. Dan Niles of Niles Investment Management knows this sector better than most, and Dan joins us now for more. Dan, Happy New Year, sir, and welcome to the program. I guess my first question to you on this story would be, is this about insulating themselves from potential regulation, or do you really think this moves towards the center and away from liberal policies will actually deliver better growth, better numbers, and help the stock?
Yeah, I mean, I think, I grew up in California. I lived there for over 30 years. And, the politics have changed over a long period of time. And Meta was very left-leaning with their platform. This just kind of gets them closer to the center. I love Michael Jordan's statement from a long time ago that Republicans buy sneakers too. And I think a lot of companies kind of forgot about that. And so I think this moves them more towards the center. And that on the margin, that should be helpful because everybody hopefully feels a little bit better about the platform.
Dan, how much, when you take a look at 2025 performance, particularly in the tech space, how much does regulation play into it at a time where there are increasing national security concerns and we talk about the sort of increasing decoupling between the U.S. and China?
I mean, I think it's a big deal because in China, their government tries to support their biggest companies. They want their biggest companies to dominate worldwide because China wants to rule the world. And in the U.S., we've sort of developed this policy of, we need to hamper our big tech companies. But guess what? If we hamper our companies and other countries are trying to help theirs to dominate, that puts the U.S. on a national security level in a very bad spot. So the government should really be trying to figure out how do we harness the brilliance we have in all of these U.S. companies, the technology they have, and how do we help our companies spread our values around the world. So I think, hopefully that's what's going to be the case going forward with the new administration, where there's a little bit more support for our technology companies. And I think that's a good thing from a long-term perspective.
I want to give you a victory lap, Dan. Last year, at the start of the year, you predicted about a 20% gain in 2024. We got close to that, more than that, but a lot of people had been expecting a lot less than that. This year, your outlook seems a little bit more cloudy. How much do you think we're going to basically take back a lot of those gains that we had last year with the threat of inflation and the threat of maybe some of the promises not coming to fruition?
Well, I mean, I think you framed it perfectly. If you look at where inflation is, and inflation's really been the biggest driver of stock prices for the last 4 years, arguably. You had big surge in inflation in 2021. Market ignored it. CPI went from 1%, 1.4% to 7% in 2021. Market went up 27%. You got into 2022, and people said, inflation's not transitory. Fed starts hiking, market goes down 19%. Inflation comes down. 2 years ago, market goes up over 20%. As you said, last year, the market was up over 20%. But this year, if you look at it, all the inflation metrics kind of bottomed in either June or Q3 and have been going up. And the market sort of has ignored that right up until Jerome Powell said, our inflation forecasts have, quote, kind of fallen apart, and the market went down 3% on December 18th. And I think that's the risk, because the Fed is probably on pause, is my opinion. You might get rate hikes. In that environment, a trailing PE of 25 times when historically it's about 19 times when CPI is between 2.5% to 3%, that's potentially a problem. And by the way, bond yields are also about 100 basis points lower than they normally are when CPI is between 2.5% to 3%. So that's why I worry about a 10 to 20% drawdown this year if inflation does in fact look like it's being sticky or moving up, the Fed has to hike. If we thread the needle and you end up with inflation not having a problem, you could see the market up over 10% with multiples holding and earnings growing 10%. But that's why I feel like, cash is one of my top 5 investments for starting this year. Last time I had that was in 2022. Market went down 19%. We'll see what happens this year.
Dan, I was just looking at your 2025 top 5 picks, and below cash, you had Cisco. You just talked about these big Chinese tech companies and why there needs to be strong U.S. tech companies. Are you concerned about what's going on with Chinese hackers? Because Cisco was named as one of these companies that Chinese hackers compromised their large network routers.
Well, I mean, the Chinese companies have compromised Cisco. They've compromised the Federal Reserve, which you might remember got hacked. I mean, it goes back to what we talked about earlier, which is you need to support the U.S. companies and what they can do to try to make America's defenses better. And so I think with Cisco, it's one of our top 5 picks. They've got some good security products that obviously all security across all companies, even the security software companies have gotten hacked, which you probably remember. Mm-hmm. I think that'll really help U.S. networks. And it's one of the reasons we have some of our top picks like Adtran, which is you're starting to pull Huawei out of a lot of telecom networks now in Europe and replace them with more friendly country technology. I think that helps one of our top 5 picks, Adtran, as you roll out that technology in Europe, you pull out Huawei out of a lot of those networks as well.
So basically, anything that is U.S. tech will dominate. Do you think that is because the political policies, or that is because these companies just no longer trust this Chinese tech?
It's taken a long while for Europe to kind of get there, but they've finally gotten there. The U.S. obviously started going down that path many years ago when we had President Trump's first term. And so Europe is sort of catching up to that. And I think that's a good thing. And it should help U.S. tech companies where we might not have the lowest cost product, but hopefully it's a little bit more secure and in alignment with our partners in Europe.
Dan, we've got a lot to talk about in 2025. Looking forward to catching up again soon. Dan Nels there of Nels Investment Management. Got a lot to talk about a little bit later as well. 11:30 Eastern Time. Bloomberg's Ed Ludlow sitting down with Jensen Huang live from CES in Las Vegas. Looking forward to this one.
How many leather jackets do you think he has?
I've got no idea. Danny was mentioning earlier that maybe that had sort of like crocodile leather on it, and that's why it was glistening.
Or it was glitter.
In the lights. You notice that?
I think these are the important questions that we want to know,
Everyone's
obviously.
commenting on the same thing. I couldn't care less.
Yeah, well, I do think that it sort of is a trend setting, I mean, this is what Mark Zuckerberg's trying to do with his new look, his necklace, T-shirt.
Wear what you want when the stock's up 300%, right?
I mean, basically.
You can get away with absolutely anything. Wear the same thing every day, all the time.
Yeah.
Do whatever you want. Things get a little bit more dicey when the stock's not doing well.
Well,
do you remember when Zuck used to go around with the hoodie all the time?
I do.
Yeah. It was great when the stock's up.
Right.
And then the stock wasn't doing so well.
And all of a sudden it was the cost cutting and we got serious.
He used to put a suit on.
Yeah, exactly.
Put a tie on.
Yeah, necklace. Look, with Jensen Huang, I think it's going to be really important that he shows how this is going to potentially go beyond just NVIDIA. And that, I think, is sort of a question. Yesterday we heard why this is great for NVIDIA. With the promise of it expanding, I think a lot of people want to say, show me the money elsewhere.
The biggest clients have spent a lot of money on this. And I think it's the investor patience of the biggest customers that we've been watching for, whether it breaks or not, over the next year or so. And it's one to watch for 25. Up next, we'll catch up with Dana Peterson of the Conference Board, and we'll catch up with Brian Weinstein of Morgan Stanley Investment Management. We'll do all of that in just a moment. From New York, this is Bloomberg.
Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Checking on stocks. Unless you want to talk about that. You want to talk about that?
No, let's go. Let's
Good.
talk about stocks. Yeah.
Lisa's Googling how many leather jackets Jensen's got.
At least 7.
At least 7. Okay.
Yeah. One for each day.
He's got enough money, hasn't he?
Yeah.
Equities right now in the S&P, up by 0.1%. With 60 minutes to go into the cash open. With your morning movers, it's Manus Cranny. Hey, Manus.
Jonathan, let's kick it off with NVIDIA. I mean, there's a host of notes now come into your inbox in terms of what Jensen Huang said to the market yesterday. I like what Steve had to say. The announcements on robotics, the announcement on automation, the announcement on going into hardware is about deepening the moat of real uniqueness around this stock. Dan Ives, the evangelist of Jensen Huang, we know the phrase, the godfather of AI, but he talks about a 5 trillion market capitalization in the next 12 to 18 months. That's a pretty staggering uplift from the 4 trillion he originally had penciled in. What are robots worth? The whole business, the whole world, probably about $38 billion. Auto business for this company by 2026 will be worth $6 billion. And that personal hardware is now an entry into personal hardware for those AI supercomputer developers at $3,000 a touch. So there's an evangelist moment for Jensen Huang, but there's a halo effect onto Uber. It's our data on your systems. That's essentially what we're hearing here, which is Uber's going to give the data to NVIDIA, and we're going to have a magical moment in terms of autonomous driving collaboration. And this is about leveraging the Cosmos platform. So this is about symbiotic coalescing of two major tech companies. And as Dara Khosrowshahi said, it's going to supercharge the timeline for safe and scalable autonomous. Tesla, speaking of autonomous, of course, we know that Dan Ives has said 15 to 20% of this company's valuation is the cars. The rest of it is autonomous driving. Bank of America takes a bit of a pop at this morning. They downgrade on valuation and execution risk. Yes, they upgrade the price target of $490 from $400, but they talk about elevated costs. Sidebar, the US, of course, has blacklisted one of the major suppliers of batteries into Tesla in China. Jonathan.
It's quite a story. And overnight, Manus Cranny, thank you. That's the latest on the corporate side of things. Lots of economic data in the next several days, including payrolls on Friday. The estimate in our survey, 163K. This came from BNP Paribas. This is what BNP's take is, and I think it's an important question for us all going into Friday. What would it take to this Fed to cut interest rates at the end of this month? We expect the Fed would require a clear miss in key dimensions to spur a rate cut this month. So they'd be looking for, Lisa, payroll growth well below 100K and a jobless rate above 4.3% to get this Fed to consider cutting interest rates at month end.
Would that even be enough, though, given how much we've seen the long end increase and how much they've talked about patience? Would one print that arguably people could say would be noisy for a whole host of reasons, would that be enough? A lot of people are going to be looking at the internals of this report. What's wage growth look like? Where is the employment coming from? Is it mostly still coming from government positions? And those are some of what will go into how it's interpreted by markets.
Here's the latest take from Dana Peterson of the Conference Board on the labour market data, writing labour data will be the focus for markets and the Fed this week. The Fed can be less worried about labour market excesses, but should remain concerned about the effect of higher labour costs on inflation. Dana joins us now for more. Dana, welcome to the show. Before we get to Payrolls Friday, we've got some numbers in between, just to work backwards on Wednesday, ADP and claims, and then later this morning on JOLTS. Can we start with JOLTS, Dana? What we've seen in the data so far, job openings okay, hiring has been muted, but layoffs are low. Do you expect to see more of the same?
Yes. In fact, if you think about the labor market, it's like a water bottle. The pandemic emptied out all the water, then companies had to work really hard to fill the water bottle back up. The water bottle's full, so it's much more difficult to hire new people if you don't need them. And so that's why hirings are low, but still layoffs are low. And when you look at job openings, we're kind of normalized. We're back to where we were. So I think it's a story of normalization and not necessarily weakness in the labor market.
If you speak to people who are at Citigroup, Andrew Hollenhorst's team, they talk about how a lot of the hiring so far in the past couple of months have really come from government positions, other areas that aren't necessarily representative of a healthy, ground-up, broad-based hiring. How much does this concern you?
Well, I like to look at the level of payrolls, and the level is almost back on the track that we were when the pandemic hit. So if you take a line, a straight line, and draw it up, we're almost back there in terms of the trend. Most people are working, and in fact, there are some areas where there's still a lot of hiring. It's healthcare. Yes, it's government, but these are the areas that are experiencing massive labor shortages because people are either retiring or these are jobs that have a lot of churn, right? You have to physically show up to work. You can't be a nurse or a doctor from home. So those are the areas that are hiring. But again, when you look at the levels, most people who want to work are working. So I think it's more important to look at the levels than the deltas. The deltas are going to be smaller, again, because we're at full employment.
Do you have a sense of what it would take in this report for you to get truly concerned about whether things were deteriorating?
Well, like you said earlier, it's one report, but I like to look at hours worked. And certainly hours worked are kind of back to where they were in 2019. And when you dig beneath the surface, you can see that the hours that have really fallen off have been in those sectors where there's just not much demand anymore. Sectors like manufacturing, also retail, transportation and warehousing, that's all linked to goods. People are done buying tons of goods and no services. They're at a better balance of consumption. But when you look at services, hours, they're doing great. In fact, they're rising, and even for construction, they're rising. So I think there's a lot of health in the U.S. labor market because the economy itself is very healthy. And you need to be careful at what you look at in terms of bellwethers for something that's weird. But I would say we should continue to monitor the unemployment rate for people who've been unemployed for 27 weeks or more. That's after you're done with your unemployment insurance. And we're seeing that creep up a little, but still it's very low. But these are the things that I would look out for in Friday's report.
If you see that number start to creep out, would that be an unwelcome development for the Federal Reserve?
Yes, and I would actually look beneath the surface. Okay, why is the unemployment rate rising? Is it because you have a bunch of people who are being let go, or is it new entrants and re-entrants to the labor market? And again, if you're entering the labor market at the tail end of a boom, it's going to be much more difficult for you to find a job because guess what? All the positions are full. And again, most of the hiring that we're seeing are in those industries that really need workers. There's a lot of churn. You have to physically show up to work. So you have to also raise wages to accommodate that. And just looking at wages, wage growth, yes, has slowed significantly from the heady days of the Great Resignation. But wages are still growing at a pace that are much higher than we experienced in the 10, 15 years before the pandemic. Also, when you look at the ECI, wages plus benefits are both growing at very elevated rates. And companies are not absorbing that into their bottom lines. They're passing it on through inflation. And I think that's one of the reasons why inflation gauges have been sticky, especially services excluding housing.
Dana, you just said there the end of a job boom. Is that how you would describe where we are right now in the labor market? And then what comes next?
Yeah, so we had a huge boom to refill all the jobs that were emptied out, that were vacated at the worst of the pandemic. It took several years for us to get back to that level. And again, when you look at the level, we're much higher than we were at 2019, almost back on the path that we were heading to anyway. So that tells me that the labor market is doing great. So it's really those people who are frictionally unemployed, people who are waiting to jump back in. Now they're having difficulty because companies don't necessarily need them. And indeed, when we talk to CEOs of large firms, close to 80% are saying either we're going to hold on to the workers we have because we're happy, or we're going to continue to hire. Only about 20% are saying, look, we're going to be letting people go. And that's really low. If 80% are saying, we like the labor market and we're going to continue to keep it strong, I think that's something we should pay attention to.
So, Dana, just to wrap it up and put a bow on it, given the confidence numbers we've seen from your company and elsewhere as well, for consumers and for businesses alike, you don't think that necessarily is going to lead a pickup in hiring in the months to come?
Well, again, it's like if you're a company and you need 20 workers and you have 20, you're not going to hire that 21st. But the key thing for consumers is the fact that they are working. Most consumers who want to work are working. Again, their wages are growing at a much faster pace now than they were 5 years ago. They have income, they have savings, and I think consumers are going to continue to have that ability to spend. And let's not forget, inflation, the rate of change in prices is much lower. Yes, the price level is higher than they'd like and certainly higher than we were in 2019, but at least prices aren't rising at a rapid rate. So those are all components that support consumer spending. So again, as long as most people are working and they have income, then I think they're going to spend.
Well framed. Dana, good to hear from you. As always, Dana Peterson there at the conference board on the economic data still to come this week, including payrolls on Friday. Later on this morning, the JOLTS job openings report and ISM services. So a lot to look forward to at about 10 a.m. Eastern time. Michael McKee, our Bloomberg economics and policy correspondent, joins us now for more. Good morning to you, Michael. What are you expecting from those numbers a little bit later?
Well, not a whole lot. The ADP numbers are expected to come in a little bit lighter tomorrow, so JOLTS maybe not going to influence the views of that. And at this point, JOLTS has kind of fallen off the radar for the Fed in terms of what it's telling them about the economy. ISM services will be interesting because people will want to see what it is we're getting in the employment side. Again, looking towards Friday. I do want to mention that while you were talking with Dana, we saw the U.S. trade balance for November come out much higher than expected at $78.2 billion. It was the highest since 2022 because of the port strike threat and Trump tariffs. We imported a lot more stuff, but here's the kicker. We're looking at what's going on with China because obviously Donald Trump is making a big deal out of putting tariffs back on China. We imported less from China in November than we did in October. And you look there, that's when Donald Trump put on the tariffs the first time. And what happened? The trade balance actually widened. So at this point, it's hard to know exactly where we're going to go with all this, but I am going to predict that the trade balance going forward once we get into the Trump administration is going to be one of your new favorite indicators.
We'll definitely be watching that closely. In the meantime, we're looking ahead to Friday's payrolls report, and I'm wondering what you're looking for in terms of the internal metrics that could potentially be really important for the Fed.
Well, the Fed is really going to be looking at the unemployment rate. That's what they've made sort of their lodestar for where they go from here. But it's also going to be interesting to see how many jobs are created. There is a very, very wide range of forecasts for jobs, from less than 100,000 to almost 300,000. So if we get a big number, then that is going to suggest to the Fed that they could keep cutting rates. But if the unemployment rate goes up, then they're going to be talking about, well, maybe we need to keep the pressure on. So let's see what happens on Friday. It's kind of hard to tell at this point.
Hey, busy Mike McKee this morning as well. Mike, looking forward to your coverage a little bit later, 10 a.m. Eastern time for JOLTS, job openings and ISM services. Joining us now, Brian Weinstein of Morgan Stanley Investment Management. Brian, good morning. Good morning. And a very happy new year to you. The 10-year bond yield this morning, 463. You think that's child's play? 525, 550.
That's right.
Is what might be the real test later this year. Are you expecting that to happen as a base case?
This is the first time I've been here where I think we can start to think about the 10-year note making some sense, right? At 460, 2% growth, 2% inflation, a little term premium. So we're now getting to an area where it's interesting. But stocks are at the highs, right? I mean, we've been here before. We've been at 460 10-year notes. You said in the UK, it's been since 1998, right? Since we've had these rates. It's not where we are yet in the US. So we're getting interesting. But if we're going to talk about US exceptionalism and growth and tariffs and things that change prices higher, I don't think 460 10-year notes are going to be the thing that stops us.
The path of least resistance for the year ahead then, higher yields?
I think we'll be more two-way starting around here, right? We've had a big move. It was very quick. No one expected it. I don't really understand why we rallied into the Fed like we did, and the path of it we can argue. But I think the steeper yield curve makes sense. The rate level starts to make sense. And any weak data will start to rally it. But I think when we get to June, somewhere between June and September, we have to test the stock market with a rate that matters. And to me, that rate is 5.25, maybe a bit higher.
So basically, buy tactically now and then sell and then wait.
If I was going to buy something, I think I'd buy the front end, right? Because if you start to think about, something like a negative payroll or something, a really bad data point, right? Listen, unless the stock market crashes 30%, you're not going to get a 100 basis point rally in the 10-year note. But you could price in Fed eases again. So the front end, I would buy. I would wait for duration. Listen, you could trade it around from here, I guess is my point. But I do think you're at the beginning of a fair value in a 10-year note, but not the end of the story.
I've been struck by how many guests this morning have talked about the potential for some sort of 2022 repeat, the idea that bonds and stocks could sell off in tandem, and the idea that we could essentially get bond yields that climb and pressure stocks kind of akin to some of the trends we've been seeing over the past couple of days. What kind of likelihood do you give that scenario?
I think it's very, very high, right? So if you look at the long term, the last 3 or 4 years, we are at effectively the highs in yields and effectively the highs in the stock market. So the correlation is positive, right? I think that has to change, right? It'll go back to 2022. So I do think if interest rates were 5.25, which puts real rates at, I don't know, 2.5 or maybe even a little bit higher. So you've got 2.5% risk-free growth plus 2 and change for 3% inflation. If you get a 5.5% risk-free return from the government, I think you have to question all your risk allocations. So yes, I think that we're going to that point where rates are the things that pressure equities.
Dan Niles was on earlier and he said one of his top 5 allocations is cash. Do you agree with that?
Cash is one of everyone loved cash last year, and listen, it did what it was supposed to do. It gave you, 5%, and unfortunately, stocks gave you 25, right? So it didn't look as good as you wanted it to, but it's certainly better than zero. I don't know if it's my favorite allocation at this point, but yes, I think it's supposed to be a growing part of an allocation when duration is not cheap and stocks are pushing levels where we haven't seen valuations like this in a really long time. So I don't think it should be a number one allocation yet. But I do think as the year goes on, cash is going to be something people will revisit. But again, I think not until stocks, you have to have a chance to reflect on all this new policy that's coming, right? So this U.S. exceptionalism story, the idea that prices are going to go up, the idea that consumers are going to spend, which I think we just heard a good argument for, I think that's all still relevant. So I don't think you have to rush into cash, but it's something you're going to want to own later this year.
Torsten Slok joined us earlier, and he talked about how the move in rates has been so unusual, and he gave all these reasons why. Questioning, is it fiscal worries, less demand from abroad, were the Fed cuts unjustified? What do you give this reasoning to?
Yeah, I love reading Torsten's stuff. I think it's an interesting debate. I don't think it's an unusual outcome. I think the path was very strange. I think what happened was when the Fed started cutting rates, everyone loves liquidity, and everyone remembers the last few times they cut rates, it went a lot further, the economy fell a lot harder, and listen, zero rates were in play, right? So you bought duration. I think people followed the playbook of the last 10 or 12 years. I think to me this looks a lot more like the playbook that came before that, where Fed funds rates weren't going to zero, the Fed was just calibrating. And again, I think the political outcomes were different than everyone expected, which also supercharged that sell-off.
We're getting some markers in the sand on the political outcome. One of them is Speaker Johnson is talking about April, May to get this one resolution, at least one of these packages, if it's going to be 2, out the door. Is that, for you, a marker in the sand potentially in terms of, okay, right now we can just deal with this volatility, but at least we have an end game on what the chatter means for policy?
I think it's important. I think it's really important to see with a very small majority how many people come along for these things, right? Because again, if you do get the policy that's been promised, a lot of it's in the price, but there's a lot of skepticism as well. And tariffs, we can argue about the economic textbook implications of it. What everyone is going to see is another change in price level higher. And that is going to cause people to spend more sooner and make things, I think, make the inflationary pressures more sticky. So yes, I think if we can see a move towards a big bill in May, it will convince the markets that this story, that there could be another round of growth in this thing, and that would be a big deal.
I'm hearing a lot of skepticism from you. I'm hearing sort of this bearish overtone that is sort of unfortunate to me that I haven't heard this in a very long time. Are you going to come out and actually be bearish?
We're getting to a point where a lot of this is in the price. Yes, I think if we got to that point where we saw the unification and a big bill coming, and we got 10-year notes to 5.25, I think you're going to reverse some of these trends, right? I don't know that I look at 2025 and see another 20-odd% return in the equity market. It could be a great year for bonds after a really bad start. So I think it might be a tail. It's really hard to time. A tail of 2 years, or maybe it's the first quarter is really strong. But yes, I do think allocating the cash at some point, getting ready to buy duration at some point. These are things we haven't wanted to do in a long time. They're coming, and I just don't know when.
If you're bearish on US bonds, I just wonder how bearish you are on bonds elsewhere. We're questioning the fiscal space already in places like France and the United Kingdom. At least here in America, you can have an argument that bond yields are going up for the right reasons. I'm not sure you can abroad right now, can you?
No, it's messy abroad. It's messy abroad. I mean, look at the euro, right? I mean, the euro going to parity is kind of, I think, the way it's playing out in Europe as opposed to yields, because there isn't the same growth story. There isn't the same inflation story. So it could change. I don't have a big view. There's certainly a mathematical relationship between European yields and U.S. yields, so you can stretch that for a while. But eventually, you're going to want to move your underweights to Europe duration instead. The U.K. is the hardest one. It always is.
Big time.
It always is, right? The U.K. led us in the 90s, remember, and 2000s, they pushed their long-term investors to own a lot of duration and pushed their long rates way down. We thought it was an aberration, and Japan was an aberration. They were the leaders, right? And now it's changing. I don't have a great feel for where the UK long end could go. It seems a bit messy, the entire situation there. But yes, at some point, the European story will become much more interesting.
I forget the average maturity profile of the UK debt market, but it's certainly north of the United States.
Way north.
By quite a multiple. Brian, it's good to see you, sir. Brian Weinstein there of Morgan Stanley Investment Management. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Meta is revamping the company's approach to free speech. CEO Mark Zuckerberg says Meta will drop its third-party fact-checking and move to community notes similar to X.
After Trump first got elected in 2016, the legacy media wrote nonstop about how misinformation was a threat to democracy. We tried in good faith to address those concerns without becoming the arbiters of truth. But the fact-checkers have just been too politically biased and have destroyed more trust than they've created, especially in the US. So over the next couple of months, we're going to phase in a more comprehensive community notes system.
Meta will also lift restrictions on some topics and take a more personalized approach to political content in the US. Hedge fund Bridgewater Associates has laid off about 7% of its workforce, affecting about 90 employees. A spokesperson for the firm said that the layoffs are meant to keep the organization nimble and flexible. The cuts now bring headcount back to where it was in 2023. Fellow hedge funds Two Sigma and Brevin Howard also cut about 10% of their staff last year. Toyota is aiming to open a futuristic city at the base of Mount Fuji later this year. Toyota says the first 100 residents of the so-called Woven City will move in soon, mainly Toyota employees and their families. Woven City aims to be a living laboratory for testing and developing new technologies, but Toyota's chair has said it may never be profitable. And that's your brief, John.
Danny, thank you. I'm not sure if I want to be part of a living lab, but the accommodation looked quite nice, didn't it?
I don't know. It looks like if you get free accommodations, and it's not going to be profitable because you're getting more value for
and apparently flying cars.
Yeah.
Yeah, that's what they talked about.
At some point in the future, who knows? Up next, setting you up for the day ahead, tons of economic data this week. It kicks off a little bit later this morning at 10 a.m. Eastern Time. We'll run you through all of that in just a moment. From New York, this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. We've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The opening about 35 minutes away. Equities positive by 0.2%, up nicely, and to build on the gains of the past few days. Let's see if this holds. Here's the trading diary for the rest of this week at 10 a.m. Eastern Time. JOLTS data, ISM services Wednesday, ADP private payrolls and Fed minutes plus, another round of jobless claims. And on Friday, the big one, Bramo, payrolls Friday just around the corner.
I just have to stop for a second and say, after all the euphoria of American exceptionalism and bullishness and how these are equity markets that can just keep going up, up, and away, carried by AI incredibleness, we are hearing real bearishness for the first time. And I want to just put a linchpin in that, because really today has been all about how we could see a repeat of 2022.
It's based on the guess we've had, right? Torsten Slot came out with the repeat of 22 line, and we sort of built from that.
Okay, hold on a second. We heard that from a number of guests. Dan Niles, we heard that also just now from Brian Weinstein. I mean, this is not just one guest.
People were baking in policy, which is why I'm looking forward to tomorrow to seeing if we get any more tea leaves, breadcrumbs on actually what the legislation and what Trump's agenda will actually look like when they write it down.
For 5 minutes in 2025, Lisa was on the edge of bullish.
Okay,
one morning, 3 guests. The whole thing's gone away.
Well, three makes a trend, so that's officially a new trend. We're hearing new nodes of bearishness.
Hyper-dependent on the next data point. We'll get more data later on this morning. Coming up tomorrow, Andrew Holdenhorst of Citi, Mike Wilson of Morgan Stanley, Alicia Levine of BNY Wealth, and Greg Dacko of EY. Looking forward to that. From New York, thank you for choosing Bloomberg TV. For our audience worldwide, this was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, could we be in for 3 days in a row of gains to kick off 2025? 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, NVIDIA drops the mic at CES, unveiling new chips, software, and services. The CEO is going to speak to Bloomberg's Ed Ludlow later this morning.
And Meta makes major changes as it gets rid of fact checkers and elects Trump ally and media exec Dana White to its board.
And the pet economy, Bark, which offers everything from treats to toys to a doggy airline, saw its stock soar by 128% in 2024. We'll speak to the CEO next hour. All of that and more coming up. Let's take a look at where markets are trading right now. You can see green on the screen behind me. It's interesting to see the S&P 500 leading the big tech NASDAQ 100 right now. You have NVIDIA shares up about 2.4% at the moment, but that's not translating into big tech leadership. But overall, we are a little bit higher. You take a look at the bond market, pretty quiet right now, of course, at very high levels. The 10-year Treasury yield trading at 4.63%. We do get some JOLTS data later this hour, I believe right at 10 a.m. That is a little bit of a preview for Friday's jobs report, and the long end will be something to watch.
Yeah, absolutely. And we're also seeing that yield high above the S&P's earnings yield. In fact, this is that chart. It's the biggest delta that we've seen to the downside since 2002. So more than 2 decades since we've seen the 10-year yielding this much more than the S&P.
Very hard to break apart that relationship between the bond market and the equity market, but certainly stunning chart. Again, Matthew Miller. Some stocks we're watching NVIDIA, of course. All eyes are on it this morning after it announced a new lineup of AI products to the pipeline, new gaming graphics, AI, desktop computer, partnerships to prepare for autonomous vehicles. That includes a deal with Uber, which is higher significantly today as well. NVIDIA up 2.5%, Uber another 2.7%. In addition to yesterday's gains, of course, on some capital return. Micron up 4.6%. It's been tapped to supply a new lineup of GPUs, and that's just the start, Matt.
All right, yeah, absolutely. There's so much going on. A forecast for 1 billion humanoid robots from Jensen Huang, a forecast for 1.5 billion self-driving cars. And that's more than the global auto fleet now, right? We only have 1.47 billion cars on the road around the world, so...
Well, I guess in this futuristic society that Jensen Huang is imagining, the robots will drive the cars, right? Is that how
they're
it's gonna work?
separate.
Well,
They're
then,
separate.
Maybe we're going to make a lot more people, but it was really interesting to see him deliver in the crocodile jacket, and interesting to see him spread the love, too. I mean, NVIDIA shares, yes, they're higher, but really the action in Micron and Uber, you also have some smaller companies as well, Aurora, also feeling the love today, because this vision for the future that Jensen Huang has...
Even smaller, Arby, which is like a $300 million company.
I had to look that up, but they're going to need partners, and that's what you're seeing.
Good to spread the love. You look at just how much some of them are rising. Of course, Aurora is a lot down to the driverless trucking industry. So really a well-rounded vision, a little bit of something for everybody. I know, Matt, you were kind of looking earlier today at a chart that showed just how much gaming has compressed as a percentage of its total revenue. Data centers just building, Microsoft still being the largest component of the revenue for NVIDIA if you look at SPLC.
Back in 2022, way back then, remember the end of the pandemic?
Barely.
Gaming was still the biggest chunk of NVIDIA's revenue. Look at the sales breakdown for 2025 estimates. And gaming is just $12 measly billion of...
You think about the future there, too. I mean, right now, their biggest customer is Microsoft, but the next step is apparently rolling out these hardware and software to a larger swath of business and also government agencies. So, I mean, at least in Jensen Huang's world, the sky is the limit right now.
Let's talk about all this with BlackRock Chief Investment and Portfolio Strategist for the Americas, Gargi Chowdhury. She joins us here on set. Great to have you, Gargi, here at 731 Lex. I want to get to the premium that I was showing earlier for treasuries over the S&P, or even more triple B bonds over the S&P. But we can't ignore this massive NVIDIA announcement. I mean, to some extent, it's self-hype, right? But it's a $3.7 trillion company now. How much of a driver is AI and NVIDIA going to be in 2025?
Good morning. Happy New Year. It's so great to be here with you all this morning. And your question is actually the crux of what we're talking about in our year ahead outlook that actually we published today. And one of the things that we talk about there is the continuous impact of AI and the way in which investors should sort of think about investing with that theme in mind is continuing to focus on large cap companies, continuing to look at the intersection of what we call growth and quality, because that has been the driver in 2024. And we think, at least based on our projections of earnings, that's going to continue to be the driver of markets in 2025 as well.
From a valuation perspective, how do you break from the pack and look outside of NVIDIA to find better ways to look for gains? You're seeing the companies at sky-high valuations meet some resistance from investors. NVIDIA being an exception, but you saw today Palantir being downgraded, for example, worries about Tesla valuations. Are parts still looking a little frothy?
I mean, this has been the biggest concern for clients that we speak to across the US over the last sort of, I would say, 6 to 12 months, right? Even before this 25% return we saw last year, clients were concerned about valuation. So the one point that I'd make is, number one, it isn't just tech and comm services, right? I mean, obviously that was the story of 23. 24, you did have that broadening out. And I think that's a really healthy sign for the markets. Number two, I think thinking about growth is really important here, thinking about earnings growth. So yes, to your point, if you look at PE multiples, those are obviously at, we think 22% premium over the last 10 years. But what is important to remember here is we are seeing earnings growth. So when you look at the 6 or 7 largest names of the S&P 500, those are the ones that are growing at about 6 times the rate at some of as compared to the 493. So looking at quality, and we look at
But isn't that going to slow down drastically?
It's going
in 2023, I think the Mag 7 was earning 63 percentage points more than the S&P 493. Last year, it was like 33 percentage points more. This year, it's supposed to be 7 percentage points more. So that premium is contracting at a drastic rate.
It is contracting, and that's the point I was making earlier around the breadth returning to the markets and continuing to return to the markets, which is a good thing. And I think it entices more investors into broader swaths of the market, but it is still higher. And that's obviously now, and we've looked at earnings revisions over the last 1, 3, and 6 months. Those have continued to trend higher and perhaps continue to do so. So I think there are 2 points that we're trying to make here. Number one, there is that compression that is taking place when you look at just the top few names versus the rest of the index. And I think that's good for the markets, which is why we're focusing on things like quality. This is why we're focusing on things like a dynamic rotation fund. And then on the flip side of that, you're also continuing to see the strongest cash flow generators being in the large cap growth names.
Well, I want to draw this point out a little bit more because, Matt, you're talking about the compression that we're expecting in earnings. And if that's the case, the broadening out that you're describing, is it more of a catch down for some of these heavyweights that have been leading the market versus a catch up for some of maybe the names that haven't been participating as much?
You know, I think this is a time, I mean, 2025 we think are going to be good for markets, but I think you have to be a little bit cautious about broad everything outperformance. And, you know, when I think about what might not do as well in this higher rate environment, and I'm sure we'll talk about fixed income in just a little bit, but some of the catch down might happen in areas like small caps, frankly. You know, we've spoken about that with you here before. We saw the everything rally in November, and then in December we saw an unwind, especially in the small cap space. So we think focusing on, again, large cap, quality, and there are areas of cyclicality too. We're talking about banks and brokers, specifically within financials, which we think would benefit strongly from the continued steepening as well as the deregulation. Where can we see a catch down? I think the broad everything rallies, small caps participating in that in a higher rate environment may not necessarily work.
Yeah, let's definitely go to rates because you do hear some investors saying, okay, we should take on some duration risk, but even the 10-year still is fluctuating and potentially with significant upside in yields. We've heard investors talk about 5%, 5.5%, even 6% on our various programs here at Bloomberg. But what if you look even further out? In the last month of last year, you saw a lot of finicky investors when it came to BlackRock's own holdings of longer-term treasuries into TLT. Popular trade early last year. You're seeing some money come back this year. How do investors feel 10 years out or more, particularly given there's a lot of uncertainty around fiscal risk?
Yes. Absolutely, Shonali, and that is such an important driver of what we talk about in our year ahead outlook of fixed income. So not all fixed income should be painted with the same paintbrush. There are areas of immense opportunity within fixed income, and you saw that in 2024 as well. Something like a BINC that returned close to 6%, you saw the front end of fixed income having pretty decent returns, but of course the long end, and you talked about the outflows in TLT, we certainly saw investors moving away, getting a bit cautious about the lack of term premium in the very long end of the market. I think that continues, at least now, based on valuations. Despite some term premium coming back over the last month or so, I think there's more of that there. So fixed income, really attractive. I think this year it's much more about income rather than duration. So keep your fixed income duration in the sort of front end to belly, avoid the long end, and then think about income within high yield, within CLO.
I will note that TLT still took in nearly $5 billion last year. That wasn't, of course, the $24 billion that it saw in 2023, but still people looking for pain in the bond market going into that long duration. But I am curious when that flips. We talk to Rick Reeder every month on Jobs Day. He's still happy to sort of sit shorter in the belly. What do you need to see for people to really feel more comfortable stepping out?
Do you mean stepping out all the way to
duration.
the 20-year part of the curve?
Well, maybe
or
even
maybe
the 10-year.
Yeah, I like the 20s, Katie, as you know.
You're the only one.
Look, I think a few things that we have to remember. There are investors that even now, insurance investors, pension investors, that are fully funded, that are going down the glide path and looking for protection in the long end of the curve. And obviously at 4.8%, that to them may be attractive. But we think actually being in the front end and looking at income is a more attractive opportunity. For investors writ large, I think, we can certainly see some more term premium. We're just now normalizing back a little bit. Historically, if you look at where the term premium has been, even if you look at just the ACM numbers, they've been about 50 basis points or so higher than here. Am I saying we're going to immediately rise 50 basis points in the 10-year part of the curve? Maybe not, but that could happen. The other thing that I think we need a little bit of certainty on is just what's going to happen with the fiscal picture. I think we're going to hear more about that as the inauguration takes place, et cetera. But I do think this unknown of more Treasury issuance coming to the market will keep the buyers away, especially if you can earn that in the front end.
Keeps the buyers away and drives yields to 5%?
I think it keeps the buyers away from the long end to other parts. Let's remember that there were 35 consecutive months of fixed income inflows into ETFs. Investors are buying fixed income. There's this amazing opportunity that they're recognizing. They're just not buying it in the long end. And I think it keeps them away from the long end, into the belly of the curve, into the front end, into high yield, into securitized assets.
All right. Looking at the 20-year right now, 492.
Again, you're the only one taking a look that has that loaded.
Coupons. Gargi, thank you so much for coming in. Fantastic to hear from you with your experience. I know you were in a trading desk, bond trading desk for a long time as well. Gargi Chowdhury there from BlackRock. Coming up, more on NVIDIA's blowout presentation at CES and the snakeskin jacket driving many of today's stock movers. It's really shiny.
Or is it crocodile?
This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
Getting out of high interest, look at what's making headlines around the world. Mark Carney, the former governor of the Bank of Canada and the Bank of England, said he's considering entering the race to replace Justin Trudeau as Canada's prime minister. Trudeau announced yesterday that he's stepping down as the leader of the Liberal Party. He'll officially leave as prime minister after the party chooses a new leader. Carney serves now as chair of Bloomberg LP. Jean-Marie Le Pen, the founder of France's National Front and architect of the country's far-right movement, has died at the age of 96. Le Pen ran for president 5 times, sparking global attention when he made it to the second round of the 2002 presidential election. Although his daughter assumed leadership and kicked him out of the party to broaden its appeal, the party he founded is currently the most popular in France. And Getty Images is agreeing to acquire rival stock photo provider Shutterstock in a deal that would create a combined company worth about $3.7 billion, including debt. Once the merger is complete, the company will be named Getty Images Holdings. The deal brings together 2 of the biggest providers of licensed visual content in the U.S. as AI upends the content creation market. Shonali?
And we've been talking all morning about NVIDIA's announcement of new chips, of software, its relationship with different automakers, and of course, it's holding on to its gaming business, but expanding far beyond. We're going to bring in Caroline Hyde now of Bloomberg Technology to talk about the download from CES, but also to talk about how important it is. You look at NVIDIA right now, you look at the importance of Microsoft in its client base. Then you get to Meta, then you get to Supermicro. These are large consumers for NVIDIA. They're talking more and more about automakers now. How important is it for NVIDIA to broaden its base of customers?
It's crucial, and therefore it paints a vision of the future. And he did that with aplomb, with his signature leather jacket yesterday, and reiterating every point 3 times. This is about a sprinkling of everything for everyone. Autonomous vehicles, they've got it. Robotics, they've got it. Have a vision of more than 1 billion autonomous robotics in the future. You're talking 10 million autonomous industrial units out there. Manufacturing is going to be automized here overall. And autonomous vehicles, don't even get me started, at least 1 billion of them. That is why you've got Toyota surging, Uber surging. They're coming on as partners. They're going to be using and adopting the technology or working alongside NVIDIA. But when it comes to the future moat building, this is what analysts love. This is why 70 say buy the stock, 0 say sell. They're all really liking the future proofing of their technology. But in the here and now, they say that the Blackwell is being ramped up. They're at full production. So people like that here and now take as well.
I have a lot of questions. One being, of course, what animal the leather was made out of. I don't expect you to answer
Maybe it
that.
wasn't even an animal. Maybe he's pet-proof.
That's true. Maybe
Ask his wife and daughter. They're the ones who chooses fashion. He said.
If I ever am in a conversation with them, I will ask. Also, who is going to drive all of these vehicles? Of course, these autonomous vehicles. But also,
well, no one.
No one.
No one drives that. That's the point.
Oh, no. Yeah, well,
There's no wheel. There's no pedals. It's just...
Yeah, but do we need that many cars? Who's going to ride in them? In any case, I want to talk more about future-proofing because everyone is gunning for NVIDIA's lead here, especially in the chip industry, but also in some of these applications as well. I mean, how front and center do you think that is for Jensen Huang as he paints this vision?
Yeah, he doesn't want you to just think, oh, goodness, they only depend on Meta. Microsoft, which I have to say, Microsoft's $80 billion commitment to AI data centers has helped his stock yesterday. It pushed it to a new record high. It's on set for another set of growth numbers today as we hit yet more records with NVIDIA. So it is important that Microsoft, Meta, Amazon are all still there, but it's broadening out for how they can become more important to governments, more important to other companies. And this is why we spell the future of actually getting into the PC area. $3,000 for a PC if you're an AI developer. Gaming, going back to their roots. This is why they're so integral to artificial intelligence and generative AI, is because the GPUs used for gaming. He's unleashed a whole new GeForce series that's going to be updating and improving imagery there. So I think it's just about being broader. And again, this isn't just hardware. This is software, this is services, this being ubiquitous to anyone who wants to be in on the generative AI game.
I started in this career covering telecoms, media, technology.
Only place to start.
At the time, in 2000, right, Nokia was the absolute leader of the smartphone market. Nobody else really even made them. I don't think it's a great comparison, but it's one of the only I can think of where one company ruled the roost and then competitors came in and chipped away until it was insignificant. Are there competitors to NVIDIA at this point? Are there any that are a real threat?
Well, there are people who are getting in on AMD and Broadcom. If you speak to the investors that come on our show day in, day out, they are ensuring that they're not just exposed to NVIDIA, but they are trying to see how AMD can build a market share when it comes to AI accelerators, that we will see Broadcom be able to actually build AI chips for the likes of Amazon, who wants to make their own chips. But you get Amazon AWS CEO on, and he's the first one to say it's and NVIDIA, not instead of NVIDIA. Everyone feels that they are integral and everyone else is being beefed up elsewhere. And remember, they are so integral to the rest of the chip ecosystem. Micron today likely to power up about 6% because they're going to be providing the memory that goes into the Blackwell products and the future chips coming from Jensen. So I think he does need to show at the moment that, look, they're not the only game in town, but they're the dominant game in town, and they have been why they're $3.6 trillion in terms of market capitalization.
Absolutely, and NVIDIA shares, I believe, hitting another record high today, or at least on track to, of course, a few minutes away from the opening bell.
Ed Ludlow is sitting down with Jensen a little bit later. He can ask him about the leather jacket.
Perfect,
we'll put it in.
Perfect. Well, that is the perfect segue, too. Caroline Hyde, really appreciate you stopping by. A huge B-Tech coming up today, coming up at 11:30 a.m. Bloomberg's Ed Ludlow sits down with NVIDIA CEO Jensen Huang for a wide-ranging interview at CES. Don't want to miss that one.
It does appear to be
Bloomberg.
crocodile.
Really?
Yeah.
Wow. Confirmed, perhaps, crocodile. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
All right, welcome back to Open Interest. Green on the screen just minutes ago until the bells ring. You can see the S&P 500 up about 0.3%. Big tech not in the lead right now, even with Jensen Huang's mic drop moment at CES yesterday. The NASDAQ 100 up about 0.2%, even with NVIDIA poised to open at a record. You take a look at the small caps, also higher by about 0.4%. Of course, we're coming off a big day of gains yesterday, even though we did close a little bit below the session highs. Still, a lot of momentum in this market to start 2025. Now, coming up with less than 4 minutes to go until the opening bell, we'll discuss the market moves with Rebecca Patterson. That conversation coming up next. This is Bloomberg.
first time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures rise across the board. So if we hold these gains throughout the trading day, it'll be the third day in a row of gains, really to kick off the year. S&P futures up 1/3 of 1%. NASDAQ futures, interestingly, Katie just pointed this out, not leading the way, only up about 0.2, almost 1/4 of 1%. Russell 2000 futures up 0.4. Near the opening bells on the New York Stock Exchange, it's Pursuit, nothing to do with my podcast, Hot Pursuits, which is out every Friday with me and Hannah Elliott. Down at the NASDAQ, because of, apparently it's Wellness Week. I did not know, and I haven't been very well this week. Aura ringing the opening bell, the very popular ring that measures a whole bunch of different life metrics. Now, in terms of the major indexes, let's get over to a Garmin girl, Katie Greifeld, not wearing an Aura ring, but keeping track of the markets for us. Katie?
It's too clunky, and also I like real-time data. I can tell you my heart rate right now, which I won't. Let's take a look at these averages, because you can see green on the screen. As Matt mentioned, the S&P 500 building on its momentum early in the week, but still a good week for the S&P 500. Same, too, for the NASDAQ 100. Of course, we heard from Jensen Huang last night. That is boosting NVIDIA today. It's boosting the benchmark a little bit, maybe not as much as you would expect. We have some weakness in Tesla, etc. But even still, big tech up about 0.2%. Your early leader, and just by a hair here, is the small caps. The Russell 2000 up about 0.4%. But my producer is saying, move on. Let's get to NVIDIA. You're taking a look at a 1.6% rally rate now. And if you take a look at this week so far, shares have been surging in anticipation and now after the fact. That's after CEO Jensen Huang unveiled a new lineup of chips, software, and other services, of course, help protect his company's lead in the AI revolution. Over the past 2 days, up 1.8%, Janali, but it hasn't seen a down day yet in 2025.
And you're watching NVIDIA also sharing the love here. Some stocks that are moving off of NVIDIA's announcement. Micron, it will supply chips NVIDIA unveiled for its suite of upcoming AI products. Micron up about 3.5% as the market opens. And Uber, because Uber and NVIDIA are partnering to drive the company's autonomous efforts. Uber up about 3.7% as the market opens. Aurora Innovation, a much smaller company, but up almost 50% as the market opens, because it's going to be helping with the self-driving technology for the trucking industry. From cars to trucks, Matt, everything is going to be driven via robot.
Yeah, exactly. Well, the robots, though, I'm pretty sure in Jensen's version of the future, the humanoid robots are separate. They're not in the driver's seat.
I know, I want to see them in the driver's seat.
Yeah, I get it.
I think psychologically I would feel a little bit better.
I get it. Tesla, has some self-driving capability, and it is moving lower after the U.S. added battery supplier CATL to a blacklist of firms labeled Chinese military companies or firms that work with the Chinese military. The list now includes 134 companies, including Tencent, but Tesla taking a leg lower on an up day on those concerns. You can put a Tesla into full self-driving.
Right.
You don't need a robot, and my buddy Alex Roy just did that and drove from New York to California. Have I mentioned?
Yeah, you've mentioned it a few times. We still have never met this man, but
I'm going to bring him in. I'm going to bring him in.
Yeah, he sounds
maybe
like
after the next trip.
an electric character there, so hopefully we'll get to meet him. But in any case, we have another electric guest sitting with us right now. Her name is Rebecca Patterson. She is Bridgewater's former chief investment strategist. Rebecca, it's great to see you.
Good to see you guys too. Happy New Year.
Happy New Year. Let's talk about the fear and loathing going on right now when it comes to the long end of the Treasury curve. A lot of caution when it comes to that rise that we're seeing in the 10-year yield and beyond, and a lot of question marks over what it means for the equity market. How are you thinking about that dynamic right now?
Yeah, I think that the level of the 10-year yield can matter psychologically short term, but the much bigger deal is what's driving the yields. If yields are going up because we have better long-term growth prospects, and that could happen from deregulation, productivity enhancements, et cetera, then you can have Treasury yields up and equities up. It's all good. But if Treasury yields are rising because of term premium, because of inflation worries, because of supply concerns and maybe demand from foreign central banks not meeting what's needed, then you can have higher yields, and that can be a bigger drag on equities. So I think this year we have to do more than just watch the yield and the trend. We have to get under the hood and keep an eye on tips, break evens, what inflation expectations. We have to keep a close watch on term premium. I would bet in the next couple months, you guys are going to have a term premium tracker on the Bloomberg terminal that we can all go to with one click or something.
We have been looking at triple B bond yields versus the S&P yield. We have a long-term chart, actually, that I think is really interesting. Check it out. This goes all the way back to the early 90s. But right now, we're seeing the biggest delta between the S&P 500 and triple B yields since 2008. I mean, aren't equities insanely expensive at this point?
Well, I mean, we all see the PEs, right? We see the valuations. They are high relative to history, relative to the rest of the world. For now, they're being supported by earnings. And I think the high valuations mean that pullbacks are easier, disappointment is easier, but for it to turn the trend on a sustained basis, I think we also need to see either a real crack, a move higher in yields that's sustained and a big deal, and or a fall in the consumer. And right now, the consumer is still resilient. It's mainly the higher end and middle income consumer, not the lower income. But overall, the consumption growth is running around 2.5%. That's resilient. So that's gonna justify that valuation and keep the market supported for now. The other thing I think we have to mention is the private sector stimulus we continue to see from the tech space. I mean, this year and next year, forget NVIDIA. The rest of the Mag 7, $250 billion a year for the next 2 years in CapEx.
Yep.
And that's supporting the whole economy, not just those stocks in NVIDIA.
I want to go back to that chart because I always wonder about measures such as this. Of course, comparing the earnings yield to a yield on whether it be, the ag or in this case, a slice of the corporate bond market. Is anyone making investment decisions based on a chart like this alone? It looks great on screen. I love looking at it.
Alone? That's not fair to say.
No, but I'm wondering, when you compare asset classes, would something like that, a measure like that, make you rotate from bond or out of stocks into bonds, or how do you actually view a measure like that?
Yeah, I mean, I think most investors today are going to have a dashboard probably built on something like Bloomberg.
As they should.
Of course. That's going to have a whole host of indicators, and they're going to give them different weights and then pull all that information together, aggregate it, and that's going to give them a reading that says, be careful, it's a yellow flag, or red, okay, it's over, it's time to start paring back. So I'm sure this measure is being considered. The question is how much weight is it given versus other factors? What we saw in the 70s and 80s is that bond yields drove the market. We saw it again in 2022. But for most of the 90s and later 80s and 2000s, it was earnings that drove the market because we were basically zero rates. Bond yields weren't moving, they didn't matter. So the question for me today is, forget 2023, that was earnings, 24 earnings. Is this going to be another year where bond yields are the dominant driver? And I think there is a decent risk that it is.
In 2022, of course, we had Torsten Slok over at Apollo calling out that kind of really dangerous moment where you can see both bonds and equities losing steam. You know, I want to pull up this note here also from Jason Furman, because if we think about the factors here that are driving those long-term yields, it's not only growth, it's not only inflation expectations, but also some of this has to do with worries about Fed independence.
Yeah.
And Jason Furman here over at Harvard makes this case that you would have less of an inflation bias, and empirically data shows that.
Yes.
Should the Fed stay independent. A day ago, we saw Michael Barr announcing that he would be stepping down from the vice chair of supervision role, really kneeling here to political pressures. What does that mean, and is Fed independence going to be a real story going into this year as we think about their role?
I think that's an absolute, Fed independence is a risk we're going to have to keep a close eye on. You know, I think the Fed in that decision, my guess would be that they think we need to focus on our dual mandate, growth, inflation. We don't want this to be a distraction, right? So he wanted to get ahead of it and help the Fed do its job. The risk, though, to your point, is that it's perceived as preemptively giving into politics, which the Fed should not and has not done historically. So I think there's a slippery slope here. And I was surprised that he made that decision without actually being told, you got to go.
By the way, we talk about all the time whether well, the market, I guess, is discounting tax cuts and deregulation much more than it is discounting mass deportation and tariffs. Right. Even if Trump pushes back, like yesterday on Truth Social against the Washington Post, when he said, no. When I say universal tariffs, I mean universal tariffs. We're not paring them back.
Right.
The market doesn't believe that.
Right.
Isn't that because, I mean, Shonali and I were talking this morning, Trump essentially won the election because of the inflation under Biden. He can't allow the same thing to happen over the next 4 years, or else the Republicans are out again.
I think that's right, that if inflation resurfaces, it's sticky or starts going higher, especially for things like groceries and energy costs, which hit the lower-end consumer hard, voters who've supported Trump. That's going to be a big challenge for the Republicans in 2 years and in 4 years.
True.
I wouldn't be shocked, though, if it happens that the administration in power blames some other force for it happening and doesn't say, oh, it's not us, it's whoever, fill in the blank. Both parties do that, but I would expect that to happen if it happened under Trump. I do think Jason Furman's right that reducing Fed independence or the perception of independence could be inflationary. The tariffs, if they happen, are going to be inflationary. Fiscal policy is going to be inflationary. I mean, that's what brings me back to this view that this is going to be the year where we all have our little term premium trackers and we're watching the 10-year yield.
Well, we'll have to work on building our own. Rebecca, it's always great to see you.
Thank you.
Really appreciate your time. That is Rebecca Patterson. Now, coming up, Meta will end third-party fact-checking. We'll take a look at the company's changes ahead of the Trump administration, many just in the past week. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
Ready? Go.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street. We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Breaking news here on the CFTC. The chairman, Rostin Benham, will step down. He plans to depart on January 20th. He said this in a statement that his final day with the department will be February 7th. So he's resigning on essentially the inauguration day. He's going to actually leave on February 7th. It's not a huge surprise. Right. He had campaigned to be the lead regulator on Bitcoin, as you well know, Shonali, because you anchor our cryptocurrency coverage, and he was an advisor to Debbie Stabenow, a Democrat from Michigan, right. So wrong side of the aisle.
Very, very against certain things, like election betting in particular, and that's something obviously that was a battle he lost, has taken off, may take off even more. Gary Gensler also stepping down. Gary Gensler also soon talking this week to our David Gura as well. So these exit interviews will be interesting to watch and see what the legacy will actually be.
All right, a lot to look forward to there. Let's get to top calls now. Some of the analyst action in focus this morning. And first up, we have Lululemon getting upgraded to buy at Bernstein. The firm says that the company's Americas business has bottomed and is poised for a modest recovery. The analyst also cites an improvement in consumer sentiment, especially from higher income consumers. Next up, Oppenheimer upgrading the Cheesecake Factory to a buy, also giving it a street high price target. The analyst over there says that the outlook for restaurant fundamentals is improving and that he expects a breakout performance this year from the dining chain. Shares up about 3%. And finally, we have Apple getting downgraded to a sell by MoffettNathanson. The firm cites its high valuation, antitrust overhang, and its weakening position in China. The analyst says that the stock is, quote, decidedly unattractive. You can see shares right now. I'm going to go ahead and call that unchanged, Matt.
That is aggressive. There are only 4 sells of the 60 analysts who rate Apple. So MoffettNathanson coming out with a big call. Now, let's talk about one of the other Mag 7 companies that's making a lot of moves ahead of the incoming Trump administration. Meta is announcing sweeping changes to its social media platform, Facebook. It will end its third-party fact-checking program and move to a community notes model similar to the one that Elon Musk's Twitter, or X, uses. The company also ending restrictions on topics like immigration and gender identity. This comes one day after Facebook, or Meta, announced UFC CEO and Trump buddy Dana White will be on the company's board. Here with more is Bloomberg's Michael Shepard. And Mike, this all comes on the heels of a trip to Mar-a-Lago for Zuckerberg, $1 million donation. They're really ingratiating themselves with the new president.
These are a lot of steps being taken in very short order to make sure that they are on the good side of the incoming administration and its allies in Congress. The Republicans will be controlling both the House and the Senate, and that will give them power also to conduct investigations and hearings that would bring people like Mark Zuckerberg to Washington to face some public scrutiny and perhaps in an uncomfortable fashion. And this is in addition to all the possible regulatory exposure that they might fear under a Trump administration if they were not in good graces with the incoming president. And keep in mind that they have not been in great favor with Trump. Facebook and Instagram banned the former president from their platforms over the January 6, 2021 attack on the U.S. Capitol by Trump supporters. And that really set off Donald Trump. He has, even as recently as the 2024 campaign, singled out Facebook as what he called the enemy of the people. So these moves by Zuckerberg are really aimed at an audience of one here, and that is Donald Trump.
Well, when you look at Zuckerberg's message as well, announcing these changes, one thing that was fascinating to me was the way he treated the traditional media versus the way he treated his own fact checkers. He really highlighted political bias even within the people that were dealing with the policies of the past. What does that mean for the way that the Trump administration converses with the American public? Is there going to be a lot of shifting in who's in charge?
Well, it's a great question, Shonali, because we have already seen the attempts by Republicans like Trump and their allies to shift around the traditional media that we have known for decades and instead try to communicate through different platforms, not only Truth Social, even during the 2016 presidential campaign, then candidate Donald Trump used X, then known as Twitter, to great effect, really rallying support and finding an audience that was willing to not only take his message, but act on it. And they feel like they get a better say when their speech is unfettered. And this has been a common complaint of Republicans, that conservative viewpoints have been shackled by the kind of content moderation that Facebook is replacing with these moves now. Now, it's important to note that this is applying only to the U.S. as far as we can tell, and it will not necessarily apply in Europe, although there are pressures on the whole free speech issue there, too, being led by none other than Elon Musk, who has complained that the European Union and the UK have been threatening to or have already imposed shackles on users' ability to communicate freely on his X platform, which he bought back in 2022. And he has really tried to turn it into this no-holds-barred space for free speech.
Well, an interesting move, of course, by Mark Zuckerberg and the new global affairs officer, Joel Kaplan, who just got the job. Bloomberg's Mike Shepard, great to get your insight. Now, coming up, Bridgewater announces job cuts as hedge funds release 2024 returns. That's next in our Wall Street Beat. This is Bloomberg.
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
And it's time now for the Wall Street Beat. We're looking at Bridgewater today because the hedge fund firm is laying off 7% of its workforce, or about 90 employees. Bloomberg's Sridhar Natarajan covers all things finance for us. This is about 90 employees, and according to people familiar with the matter, the headcount goes back to where it was in 2013. They've had double-digit returns last year at its main fund. So is this a matter of performance, or is this a matter of just reshaping things? Is it just culling at the end of the year?
Even before we get to that, let's talk about the fact that the first week of January is the start of a new year, and the first news you get out of the world's largest hedge fund is 7% of their workforce is getting cut. Even more surprising, this has come through in many conversations in the roughly 12 hours since the story broke. The language they use all these yoga terms. We are here to be more flexible, more nimble. It's just a hard pill to swallow when you describe job cuts that way. But you're right, they've had double-digit returns. They are talking about making sure that they have the ability to continue to hire talent. So there's no indication here that this is Bridgewater going to rapidly go backwards. They claim they're still on the front foot and on the offense, and they will find ways to continue to make money. It just sucks if you're part of that 7% group.
I would imagine that investors would like to hear more like bodybuilding terms, like strength and raw power.
Getting swole.
Rather than nimble and flexibility.
I think that's probably true. Certainly those 90 would. If I worked at the firm, I might say, you know what, Sri, a lot of hedge funds that have done well have cut jobs this year, just like they do every year. It's a normal annual culling. This is how the business works.
This feels a little more than your normal culling, but that is true. On Wall Street, whether it's
the biggest hedge fund in the world with 90 people?
Well, if your total workforce is 1,300, so you have to look at the percentage size. So if you're cutting 7% of your workforce, it is still something. So I would still say it is more than your normal culling, but you're right. Across Wall Street, whether you're a big bank or a big hedge fund or a big private equity firm, you're used to this reality. All these firms like to jack up, Katie, when the times are good. And when things turn around, they want to make sure that they cut off the extra baggage, what they call cutting off the fat.
Even beyond that, I remember a conversation I had with Greg Jensen just a year ago, and they were saying, okay, they built a new machine learning fund. They're trying to add more technology talent. The texture of the talent is changing. A day ago, first week of the year, as you're talking about, Citadel, with that non-compete, expanding that non-compete, what does this all say about the future of talent? Because it's not like hedge funds are going out of vogue in this season.
Absolutely not. In fact, especially if you think about the multi-strats, there is just still a lot of demand out there. Yesterday, we had the story where Citadel was increasing its non-competes to 21 months. That's really roughly 2 years off the market. Yes, you're going to be paid through that period, but that is not to make sure someone has a stressful transition into their next role. It is to make sure that you don't want to leave the seat. It is to make sure that whoever's trying to poach you cannot easily grab your talent, because the war for talent is high. And it's not just this. You remember going into last year,
right.
All through last year, we were talking about the Millennium Jane Street battle over the two traders who jumped shop. So that war for talent will stay in place, and that will be a dominant theme this year, both in terms of these non-compete terms, but also in terms of the pay packages you'll see a lot of these shops.
Sridhar, we're up against the clock. It's great to see you. Happy New Year. That is Bloomberg's Sridhar Natarajan.
Namaste.
Coming up, a conversation with Goldman's Jan Hatzius. Don't go anywhere. This is Bloomberg.
Oh,
offers before to take over Greyhound, but then in the midst of the pandemic, 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Changes are underway at Facebook and Instagram. Meta CEO Mark Zuckerberg says he's doing away with third-party fact-checking.
We're going to get back to our roots and focus on reducing mistakes, simplifying our policies, and restoring free expression on our platforms.
To do that, he says they'll switch to a community notes program written by users, similar to the model Elon Musk uses on X.
We've reached a point where it's just too many mistakes and too much censorship. The recent elections also feel like a cultural tipping point towards once again prioritizing speech.
That'll mean restoring political content and getting rid of restrictions on subjects like immigration and gender. The National Weather Service is warning of a life-threatening and destructive windstorm in Southern California that could last for several days. This woman in Simi Valley says she's prepared.
We're ready to go. Yeah, we have everything set tonight, and we're going to just monitor the news and look out the window and see how bad it is.
The winds could spark winter wildfires and power outages. Sad find at the airport in Fort Lauderdale. CBS News Miami's Morgan Reiner has the details.
JetBlue confirmed for us that during one of their routine post-flight inspections, they did find 2 people in the landing gear compartment of one of their flights. Unfortunately, both of those people were dead. At this hour, we do not know their identities. We don't know how they got through security and into the landing gear to begin with.
The flight left from New York's JFK. Lives shattered in Tibet, where a 7.1 earthquake has killed at least 126 people. This man survived.
The tremors were violent. I was terrified. My house is an old one, so immediately all of us ran out. There was chaos out on the streets.
Many people are trapped in heavily damaged villages. Rescue workers have been climbing mounds of broken bricks and using ladders to try to reach them. The World Health Community is reacting after the first human death from bird flu in the U.S. Correspondent Cammie McCormick.
The Louisiana patient was over 65 and had underlying medical conditions and was hospitalized with the virus last month after exposure to backyard chickens and wild birds. World Health Organization spokeswoman Margaret Harris.
Our risk assessment to the general population is still low, and it remains that. And we certainly are receiving information on a regular basis.
Word this morning, journalist Meredith Vieira's husband, Richard Cohen, has died at the age of 76. He was also a journalist and lived with multiple sclerosis for more than 50 years. He survived 2 cancer diagnoses as well. This is CBS News.
People love.
Americans were shopping up a storm online over the past couple of months.
Holiday shopping in 2024 surprised with online shopping records totaling over $241 billion from November 1st to December 31st. Adobe Analytics released the data, which shows 8.7% growth year over year. More than 54% of online sales were through a smartphone. Vivek Pandya is Adobe's lead insights analyst.
We've seen strong spending across the board with many major categories, especially apparel, electronics, cosmetics.
Consumers spent over $4 billion 15 different days of the holiday season. Wendy Gillette, CBS News.
A continuing study from the National Institutes of Health finds some processed foods are worse for your body than others. If you must, researchers say healthier choices include canned peaches, canned refried beans, and salsa in a jar. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube. So head over to youtube.com and start the Bloomberg podcast, and that's where you'll find us. Alex Steele, Paul Sweeney here with you. Got some economic data coming out here just as we're speaking. The JOLTS data came in. JOLTS openings come in higher than expected there. I would say meaningfully higher. And then the ISM Services Index data came out. Looks like better than expected. And we want to get right to that ISM data because that's something that's kind of moving the markets here. Yields popped a little bit higher here on the back of some of that economic data. We got the 10-year Treasury now up about 5 basis points, 4.67 on the news. Stocks pulled back. Also, S&P down just fractionally. Steve Miller joins us. He's the chairman at ISM. That's the Institute for Supply Management. Hey, Steve, talk to us about this ISM data. Alex and I are looking at this, and it looks really strong across the board. What are you seeing?
Yeah, same thing. You know, what drove the increase this month was business activity and supplier deliveries. Kind of offsetting that a little bit, we're seeing a continued drawdown in backlog of orders, but with a lower disruption in supply chains that we've seen in the month. Kind of makes sense.
Any of this related to the potential of tariffs coming on in 2025 or 2026?
Well, some of the inventory activity seems to be a result of concerns over tariffs. By far, the commentary that came through from the respondents was concerns over what tariff impacts might have. And I think we saw some of that in the sentiment around pricing. We saw quite a lift month over month.
ISM services prices paid came in well above the forecast, well above last period. How do we interpret that?
Yeah, I would directly relate that to some of the pricing activity that's coming in for next year's contracts.
Okay.
There is risk management around tariff impacts, and we saw some of the commentary talking about price increases in anticipation of what impacts there might be from the tariffs. And it was across it was 14 of the 18 industries had commentary around potential negative impact from tariffs.
So could this be the peak then for services? Like, how will that feed through?
Yeah, I think that we'll see, based on the supplier, the supplier deliveries number impact, we'll see that drop down again in January, assuming there's no port strike. And that'll give it a little bit negative pressure on the overall PMI. But this quarter is the strongest quarter we've had in a while. I believe it's since the beginning of 2023. I feel really strongly about where the number is. It's really solid growth.
All right, Steve Miller, thank you so much. We appreciate that. Steve Miller, he's the chairman of Institute for Supply Management. That's ISM with some strong numbers. All right, seeing that move, the markets here, the stocks went from the green to the red. Let's go to John Tucker and get a Bloomberg business flash. John, what do you have for us?
Yeah, so what's in the driver's seat, Alex? I'm going to say the bond market because
See, told you guys.
Okay, I'm just parroting you. As yields push higher following the resilient economic data, it begs the question, does the Fed really have to keep cutting rates? Yep. In the S&P 500, 4 of the 11 major industry groups are up right now. Healthcare, that was the best performing group. Moderna, the best performing individual stock, that was up over 10% after the first bird flu death reported in the U.S. Moderna is one of the few drug makers currently developing a vaccine for the bird flu, as Paul sniffles over there. NVIDIA, that is lower after the surge that we saw. It's among the most actively traded. Chief Executive Officer Wang announcing a raft of new chips, software and services at CES. Meantime, Julian Emanuel at Evercore ISI, he is convinced the lift from AI isn't over yet.
What we've seen is that corporate America has been slow and cautious in rolling it out. The bigger companies have adopted it more quickly. And the work we did a year and a half ago basically pointed, looking at past adoption curves, as 2025 being the big year.
Well, we are data dependent. You heard the ISM numbers. The job opening labor turnover survey finds more job openings. This is a resilient labor market, kids. 8,098,000 openings in the month of November. Right now, the S&P 500 down 22 points. The Dow Jones Industrial Average, that has turned lower, down 38 points. The tech-heavy NASDAQ 100 right now down 177 points. And let's do those yields. Let me start with the 30-year, inching closer and closer to that magical 5%. It is up 6 basis points at 4.9%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. I'm just going to go ahead and say it, you guys. Good news is bad news.
Yep.
That's what that is. Good news, job openings, ISM services. Bad news for the equity market, full stop. Like, we're back to this narrative.
Okay.
Yep, I think that gets the Fed now.
So Fed doesn't have to cut.
Yep.
Rates are keep going higher because they don't have to cut.
Or rates
because
just
it's a
stay
resilient
here. They don't
economy,
go down.
or because we're spending like drunken sailors on shore leave.
Sure, we can say resilient economy. We'll just go with that, and then the Fed doesn't have to cut as much. All right, I'm putting that out there. But let's get some more details, particularly in some of the market movers, with Bailey Lipschultz, Bloomberg News senior equities reporter, joining us. Let's talk more about Moderna and Novavax. What's going on here?
Yeah, as JT mentioned, Moderna right now up 10.5%, best performer in the S&P 500. Partly, JT, as you mentioned, that first death from the bird flu. So maybe investors getting ahead of their skis, piling and rotating back into some of those companies that rallied during the COVID pandemic. But I do want to call out some data from the CDC saying that U.S. influenza rates continuing to pick up across the country. So seeing it, at least according to that CDC.gov dashboard, clinical lab positive tests up 19% this week for the virus. So it does seem like flu is spreading. Maybe that's investors wanting to kind of guess that maybe people are going to go ahead and get shots if you haven't got one already, though typically you
the flu shot, please. My daughter got a flu shot, and that girl's home with 105 fever. Just saying, yes, you should get your flu shot. And also, she still got sick.
I mean, they're dropping like flies in the newsroom.
Yeah, you guys be careful.
This guy over here, he looks like he's ready to go.
No, my first cold since before the pandemic.
Yeah. Ooh. Thanks for coming in, though, for that. Yeah, we
coming
appreciate
in
all
in
those
this
germs.
hermetically sealed studio with us.
Also, yeah, exactly. All right, you're also looking at Uber, so this feels like the NVIDIA effect. Like at the end of the day, in NVIDIA's world, we're just living in it.
Exactly. As you guys mentioned, you saw the investors paring back expectations for a fully priced rate cut in July, so maybe that's why you're seeing NVIDIA down 2%. But as we saw Jensen Huang talking about partnerships and expanding those partnerships, we saw an announcement from Uber saying that they'll partner with NVIDIA on autonomous driving. Obviously, that's been one area that's been really hot, just given the Trump administration and ties to Elon Musk. So you're seeing Uber up 1.6%. Also, Micron right now up more than 5% after NVIDIA named the company as a supplier for their new GPUs. Alex, you mentioned kind of the NVIDIA effect. One thing to keep in mind, over the last 12 months, NVIDIA's returned 197%, Micron only 24%, Uber 17%. So when you're seeing NVIDIA pulling back from a record high, which it hit yesterday, which it hit this morning, an attitude this morning, maybe just investors kind of rotating into those companies that are beaten down or actually have more room to run, as opposed to NVIDIA, which is north of $3.5 trillion in market cap.
All right, Bailey, great stuff. Appreciate it, as always. Bailey Lipschultz covers the equity markets for Bloomberg News. Again, some economic data came in today. As John Tucker's been reporting, better than expected kind of across the board. And we're starting to see that reflected in the financial markets, in the bond market yields higher here today. Ira Jersey joins us, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, we got the JOLTS numbers. We got the ISM data. The ISM data better than expected. So how do you think the Fed's going to interpret some of this eco data we're getting today, and then, of course, for the remainder of the week?
Yeah, I mean, all the data today seem to be reasonably good, right? You still see the employment portion of that services survey what was still positive, so above 50 means that it's positive for the job market, and obviously services has really been the driver. Manufacturing, industrial sector really hasn't been doing much, but services are keeping everything pretty robust, and you're definitely seeing that in the market. To something Alex said just a minute ago about the bond market and where it's going to go, we're reaching a pretty important technical level here at 4.7 to 4.74% on 10-year Treasury yields. The 30-year at 5%, like that could go to 5.20, and it's not really that big of a deal. But if we break above that 4.7% area on 10-year Treasuries, that does potentially target a much larger sell-off here, and you could see yields approaching 5% in a hurry if that's broken. I think a lot of people will stop themselves out, will get worried. People who are long will wind up getting to, say, market weight or neutral, and as that occurs, that means you have some people, selling some rate risk for sure.
I mean, today could get really exciting, and I'm going to bring up Paul's favorite thing, which is the 10-year bond auction. But it's $39 billion. It's at 1 p.m. You already got a sell-off. You already have strong data. You're going into jobs. Are we going to have that kind of move potentially around 1 o'clock?
Well, it's not impossible that we get another tail, which means that the yield at the auction is above what the market's expecting right when the auction closes at 1 o'clock. I suspect, though, with the market selling off, that there's going to be people who are already set up and getting set up. So it's very possible that you wind up with a lot of bids that are reasonably close to what the market's expecting at that time. So part of the sell-off, the last day or two, I think is in part because of some of the supply that's coming. Remember, we also have 30-year debt tomorrow. I think that might actually have it would be a little bit better than today's 10-year, in part because as you reach that 5% mark, there's a lot of liability-driven investments that really like 5%. 30 years, and when you look at Treasury strips right now and where they're trading, they're very close to that 5% level. So you could actually maybe see some, I don't want to say forced buying, but basically people who like those kind of levels and want to lock in maybe that 30-year rate now. I think tomorrow's auction might go a little bit better. Today, as you say, Alex, is maybe a little bit more of a proper benchmark as opposed to tomorrow.
Ira, 30 seconds, soccer match of the week, go.
I'm going to be watching the Aston Villa FA Cup match. This is the 150th anniversary of Aston Villa this year. Nice. So it's one of the oldest, actually it is the oldest professional club that's still in the first division in the UK.
So the New York Football Giants, 100 years. That's big, but Aston Villa, 150. How about that? All right, Ira, thanks so much for joining us. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence, and an Aston Villa fan.
Okay, but there's also a bond auction today.
Wow. John, what is it with the auctions with this?
I was just moving on from
really
sports
need to get
there.
out more.
It's gonna, yeah, well, yeah, I also know nothing with sports. When Paul throws to me with sports, I'm like, yes, it's a thing. They do that. Anywho. All right, coming up, we'll get more on the markets. The whole good news is bad news for the equity market kind of situation. Margaret Patel is Senior Portfolio Manager at Allspring Global Investments. Get her take on the market. Plus, we'll break down that story on Bridgewater cutting 7% of staff to remain nimble. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Stock averages right now, they have turned mixed. The Dow just went into the green, up about 29 points. It looks like the bond yields in the driver's seat today. Yields are higher, stocks for the most part lower. That's because resilient economic data suggests maybe the Fed doesn't have to stay on the path of rate cuts. Growth at U.S. services providers, that quickened in December, reflecting stronger business activity. And then you had the JOLTS, the Job Opening Labor Turnover Survey, rising to a 6-month high in November, a resilient labor market in the U.S. Right now, the S&P 500, 18 points lower. That's down 0.3%, 59.56 on the index. The Dow up 29 points. NASDAQ 100 down 164 points. That's a decline of 0.3%. The 10-year yield almost 5 basis points higher. Yeah, that is at 467. NVIDIA slipping even after Jensen Huang, the CEO, announced a raft of new chips after yesterday's record close for the company. And some other individual stock news. Phillips 66 agreeing to acquire Epic NGL, the owner of a natural gas liquids pipelines, for $2.2 billion in cash. That's the refinery that Paul passes every day on the New Jersey Turnpike.
Yes.
Yeah.
I can actually see one of the flaring towers
Sure.
from my house at the Jersey Shore.
You can see everything from your house
That's
on
how
the Jersey
tall
Shore.
it is, and that thing's been flaring gas forever. I mean,
Forever.
years and years. It hasn't gone out. So
Yeah, we can do petrochemicals in New Jersey.
Oh, you do
We
that.
got your game there.
just as long as the wind is blowing
Can be the other way.
from my house.
Yeah, Phillips 66 is also moving hydrocarbons. They don't just refine them, but they move them, and that's what this deal is. So they can move around some natural gas.
The big pipeline is Colonial, right?
Yeah.
Okay. I've never heard of Epic NGL.
But there's so much activity, like in the Permian, for example, and other areas, that you want to get it out. The issue is gas, like in Appalachia, in the Northeast. That's
Can't get that
really
out.
stuck. You can't get that out at all, and all the pipelines have been, totally tossed aside. You can't get it done because you not only have federal issues, but you have state issues, and then like regional issues. It's just super hard
But
to
the
get it done.
easiest thing, or not the easiest, the best thing for just energy transportation would be to build a pipeline from there to the East Coast.
Yep. Where you're building out all the export terminals, and then you become a huge LNG exporter. Not just a big one, but like a huge one.
Right. But that's not going to happen.
I mean, maybe if President Trump can make those changes.
So as a result of not having that pipeline, when John and I, and we all here in the Northeast want our natural gas, they got it. Where do we get it from Europe? And some from because you can't send a ship from like Corpus Christi.
It's true,
with,
yeah.
So
I mean, you can. The ship just has to be licensed and run by U.S. individuals. It can't be other people, which also adds to the costs. So it's not an efficient way of moving your hydrocarbons.
Again, landman, I'm learning.
Yeah, he's learning.
Yep.
It's good now. I haven't started watching it.
Oh, it's all we're permitting, we're leasing, where you got mineral
This is on
rights.
Netflix?
I don't know. I think Paramount.
Oh, Paramount.
Mineral rights. I'm all
Billy
in.
Bob Thornton. Billy Bob Thornton is the oil man. Okay, let's get where are we going here in the market? Because now we're off the lows. So that whole good news, bad news thing in the equity market, maybe that lasted for like an hour, and now we're just down by about 0.1% for the S&P.
Exactly, and the Dow's actually up a little bit here. So, but what I wanted to go to, I'm again staying on the energy. We've got oil higher again here today, up 0.9%, but maybe it's still within this range. We're at $74.20.
Well, also remember it's cold. It's really cold, so you're
cold.
going to have more demand for heating oil and all that kind of stuff. Also, if you have any disruption because it's cold to some of the fields, etc. But that's always going to be a short-term kind of thing, so that's not going to be a long-term one. But nevertheless, the demand side really helps. Europe's also really cold, so the demand side there really helps. So, it gives it something.
And Europe is kind of, it has weaned itself from Russia after several years.
A lot of it, yeah.
Yeah.
I mean, they still get some of it, but that's why when Ukraine said, hey, Russia, you can't ship your natural gas through our country anymore, that's why you didn't see the price go bananas, because they have a ton of storage, they've sort of diversified, etc., and all of that.
You want to do that breaking headline? JP Morgan.
Yeah.
Go ahead.
Sure. JP Morgan planning to bring staff back to office 5 days a week.
In that brand new office building.
Yes.
On Park Avenue.
Exactly like Paul's been waiting for this headline for
Right.
4 years.
Exactly right. So JP Morgan, and how quickly will the others follow?
Very quickly.
That's what I'm kind of thinking here. So.
5 days a week. But I have a question. You have to wonder, will there be some flexibility? Like if you're like, hey, I need to work at home a couple days. Like, is that more generally accepted?
I think what it's going to be is you're going to be more willing to ask for it. And I think the manager will be more willing to give it.
Right.
But it's like, I need a day here, maybe 2 or 3 months later, I need another day there. Whereas before, maybe I wouldn't have asked for that flexibility. And as a manager, I may not have given that flexibility. Now I think that flexibility is kind of there.
But
now you get to work in the Death Star, though. which is what everybody seems
Is
to call
calling it? Yes. Oh, that's funny.
It looks very cool.
Let's stay on Wall Street for a second. So the other news of the morning, one of the top read stories on the Bloomberg terminal is Bridgewater. That company cutting 7% of its staff in an effort to remain nimble. Michael Moore, managing editor for finance in the Americas, joins us. But hang on a second. JP Morgan, 5 days a week, you surprised?
No, not really. I mean, the majority of their staff was already doing that, but this would be the rest of the staff. So we've seen some firms move in that direction. Others, have used the flexibility as a recruiting tool.
Citi has.
Yeah, Citi has stuck with 3 days a week for a good portion of its staff. So I think we will see a difference among the firms. Some of the European firms have used it as a recruiting tool. So, but Jamie Dimon has been very vocal about his views that people work better in the office together. It helps develop talent. So, I think it will be kind of leader by leader, kind of setting the agenda.
I don't know. I mean, the fact is, it does work from home, so that does work. But let's get people back, so we'll see how it goes. Bridgewater Associates, huge hedge fund, cutting staff. Is this just the normal culling of people, or something different going on here?
Yeah, it's an unusual one just for the reason that they are coming off their best year in many years for the flagship fund. I think the new CEO is definitely trying to shake things up a little bit. He has replaced some of the top management. They've brought some people from the outside, which they hadn't historically done under Ray Dalio. So I think this, the stated goal here is there are some areas where they want to hire. They don't want headcount to get too crazy. This kind of brings them back to where they were, a little over a year ago in terms of headcount, and allows them to kind of be a little more selective.
Did they overhire or something, or did they just want to just move focus or something like that?
Yeah, I think you have seen them announce some efforts on the AI front. They may want to do some more hiring there, but we have seen some of the hedge funds more broadly do some overhiring. There has been a talent war, so this could be a bit of a correction there.
It's a unique place to work, isn't it? What's I've heard that. What makes it unique at Bridgewater?
Well, they have they have this they've long had this culture of radical transparency, of being very blunt with each other. A lot of the senior people have been there since they were in their early 20s, have grown up there, haven't worked elsewhere. So there is a bit of an insular culture there. I think Nir Bardea, came in a little bit later in his career, so brings a different perspective than Dalio, who built this place, around his principles. So I think you could see a bit of a relaxing of that culture while still, being kind of a unique beast out in Connecticut.
Going back to JP Morgan for a second, not about the 5 days, but JP Morgan, the latest bank to quit the climate finance group. This follows Citi, follows B of A. How are we understanding it? Is this like a complete backlash against climate and DEI, for example? Or is this just sort of like we're going to move to the middle, or are we just rebranding it?
I think it's a bit of rebranding. I think they were getting a lot of heat from some politicians over some of these pledges. They wanted something with
these are pledges like we're not going to lend money to oil and gas kind of thing?
That's how they were perceived. They weren't always written that way, but that's how they were perceived. That they got the CEOs when they were in front of Congress a little over a year ago. J.D. Vance made a big point on this. So I think they thought we can do this in ways of lending to renewable energy without taking such a public stance that will get us a lot of political backlash. So I think you'll still see efforts on this, but they won't be as grand as this climate pledge that they had all signed up to.
What is this? I mean, the timing is not a coincidence, I'm assuming, given the new administration coming in. Is that how it's being read, or are they saying anything about that, the timing?
I don't think it's a coincidence. Right. I think the political winds have shifted on this. And in general, I think there is, these pledges always kind of came with an understanding of, okay, we need to help our oil and gas clients transition to this new world, so it's not going to be, cutting ties with the big oil companies, but I think they're being more cautious in that.
And it's not just, banks. We should point out McDonald's today, the piece coming out saying that it's walking back its DEI goals, saying it's changing its approach to diversity, equity, inclusion, no longer setting, quote, aspirational representation goals, instead focusing on embedding inclusion practices into its daily business. I don't know what that difference is, but that's why I wonder if it's just to rebrand. Like, now you don't want to say ESG, but if you still have some sort of like net zero goals, maybe that terminology is more okay. It's just sort of a branding and moving away from something extreme.
Yeah, I think it's not wanting to be seen as taking a political stance, more taking a this is good for our risk perspective.
I guess it feels like it's been, across the economy, maybe peak woke at some point, or peak DEI. I wonder if the pendulum, as you said yesterday, the pendulum just swinging back a little bit. So we'll stay on top of that. Michael Moore, thank you so much. We appreciate that. Michael Moore is managing editor for Finance in the Americas, Bloomberg News, joining us here in our Bloomberg Interactive Brokers studio, looking at that story. Bridgewater, big hedge fund, cutting about 7% of its workforce in an effort to remain, quote, nimble. So there you go.
Yeah.
Now, it's also, I think, when you look at some of these hedge funds, they're starting, we've seen some hedge funds return capital to investors because they're just getting too big, and they can't find the opportunities to invest the capital and generate the returns they want. So let's just give it back. And that's what we've seen in the hedge fund business over the last 20 years has been the funds, more and more money is going to fewer and fewer big funds, and they're just getting bigger, whether it's Point72 or Citadel or some of those types of people.
On the flip side, not every hedge fund is doing well. Hedge fund Hedera Jupiter has suffered its worst ever losing streak, got a 32.7% decline last year. This follows a 43.3% plunge in 2023. Yikes.
Yep.
Assets at the firm have fallen to around $818 million. 2 years ago, it was $5 billion.
Yeah, that's not good. So, performance and the money today in the hedge funds, it's just most of it is not very sticky. So you put up a bad year, not to say, even 2 bad years, then you're in trouble there. So we'll keep an eye on that.
All right, coming up, we're going to talk more about oil and gas in the President Trump administration. Mike Summers is API president and CEO. We'll talk about that day one move when it comes to energy policy. I also want to get his take on some pipelines, speaking of Phillips 66 and their pipeline deal today. This is Bloomberg. Happy Tuesday.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages, they are all lower right now. Declines coming after the latest economic data pointed to a resilient economy. So the yields pushing higher, pushing stocks lower. After yesterday's record close, shares of NVIDIA, the biggest laggard in the S&P 500. Biggest laggard? Yeah, that makes sense. ExxonMobil, the index leader, as the price of crude oil that continues its climb. And as yields move higher, Andrew Sheets at Morgan Stanley isn't so sure that's going to last.
We do think that the broad pace of this year is going to be one where inflation's coming down in the first half. The Fed is still cutting rates in the first half of the year. And then beyond that, you still have some dynamics that we think could lead to softer growth on Morgan Stanley's estimates in 2026, all supporting lower Treasury yields.
Right now, as we look at those Treasury yields, the 10-year start there up 6 basis points, 468. The long bond, the 30, is up 6 basis points. That is at 491. The 2-year, which is more policy reactive, that's up 2 basis points. That right now is at 429. We had that industry data showing service industries, that's the biggest part of the economy, expanded at a faster pace in December. Well, the cost of doing business, that increased. And then you had that separate JOLT survey, job openings reaching a 6-month high in November, led by business services. S&P 500 down 40 points. The Dow down 43 points. The NASDAQ 100, 297 points lower. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, John Tucker. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through a lens of our Bloomberg Intelligence folks. They cover 2,000 companies, 130 industries around the world. We also tap a vast network of resources outside of Bloomberg as well. Mike Summers is one of them. He's API, American Petroleum Institute President and CEO. Talks to Washington about what to do about energy. And, Mike, your claim to fame right this second in this radio studio is actually Landman on Paramount, because Paul, my co-anchor, is watching it. And now he loves it, and he thinks he knows everything about oil and gas, and he's all over it. So you're right. API is one of the sponsors. Yep. So perfect day. Good to see you, Mike. What's day one for you guys?
It's a great show, and I appreciate being with you today.
What's day one for you guys under a President Trump administration?
Well, we've laid out an API 5-point policy roadmap. You can find it at api.org of the things that we're asking this president and this Congress to do during the first 6 months of the administration. But there are some things that they can get done early in the administration, really on day one. So one of those things is lifting the LNG export pause. We're excited that we have a new president that's focused on that, and he's committed to lifting it on day one. So that's one thing we think that they can get done very quickly. The second thing that we think they can do is they can authorize a new 5-year leasing plan in the offshore Gulf of Mexico. We need a 5-year leasing plan that prioritizes new leases in the Gulf of Mexico, which continues to be a prolific region for the American oil and gas industry. About 14% of American oil comes from the Gulf of Mexico, which is why what President Biden did just yesterday in setting aside new acreage that we will not be able to develop was so concerning and so disappointing. Another big thing that we're focused on is repealing the EPA tailpipe mandate, the EV mandate that they put in place early in the Biden administration, and we'll work with the Trump administration to get that repealed and replace the CAFE standards that are draconian and U.S. automakers can't meet. So those are 3 of the key priorities that we want to focus on early in the administration. Then in addition to that, we need to get a new tax bill in place before the end of 2025. We're prioritizing things like the corporate tax rate, of course, and then really focusing on how we continue to build American geopolitical strength by expanding energy trade throughout the world.
Green energy, how does green energy work with traditional energy? I'm not sure what the preferred term is for oil and gas, but how does green energy work with oil and gas and traditional energy sources?
Well, the truth of the matter is that we know that we're going to need all sorts of energy to meet the energy needs of the future. If Goldman Sachs is right, and we're going to need 10% more energy for the next 10 years to support data centers and AI growth, we're going to need all sources of new energy, which is why it's important that we get a new permitting bill in place so that we can build out not just oil and gas pipelines, but new transmission lines for those new energy sources as well. The great thing about natural gas in particular is that it can support these alternative energy sources as well. Because we know that the wind isn't always blowing and the sun isn't always shining, you're going to need something to back that up. And natural gas is almost always the preferred energy of choice when backing up those sources. So we know that we're going to need more energy. We don't just need all of the above, but more of all if we're going to be successful in leading the future, particularly when it comes to AI. So we want to work with our partners in the other energy system to make sure that we can continue to expand.
So,
but
Mike,
we also know,
I was going to say that a popular talking point for Republicans was that we need to get rid of the Inflation Reduction Act. But if you dig into a lot of the details, a lot of the oil guys and natural gas guys like the Inflation Reduction Act in things like carbon capture credits, right? 45Q, new rules on the hydrogen tax credit, 45V were unveiled that people were pretty happy with because it had a broader swath of the energy that you could use to make hydrogen. Are you guys happy with those things right now?
I actually feel pretty good about our ability to defend the 45 tax credits. Q and V are the ones that are most important to us for carbon capture and hydrogen. We were pleased with the Biden administration rules, though we think they could be improved under President Trump on both CCS and hydrogen. So we'll work with the Trump administration to improve those. But there are provisions, I think, that under the Inflation Reduction Act that are vulnerable, particularly the funds from the Loan Program Office, which has just become a giant slush fund for favored industries under the Biden administration. So I do think the funds that haven't been obligated yet under the Loan Program Office are very vulnerable as Congress looks towards reconciliation. So that's where I think most of the focus will be.
But some of the money from the Department of Loan Office is going to like companies that produce, say, nuclear or have natural gas. Like it's not just like rando green technology. How are you going to distinguish that? Because if you need the loan in order to, say, restart a nuclear plant or work into small modular reactors, for example, what do you think about that?
Well, I think that's going to be something that Congress is going to have to sort out, and the administration is going to have to sort out. I'm pretty sure that at the beginning of the administration, what they're going to do is they're going to freeze all new funds coming from the Loan Program Office until they get a better sense as to what to leave in and what to leave out. That'll be up to the new Energy Secretary, Chris Wright. I'm confident that they'll be able to figure out what they should focus on and the things that they need to leave behind. But that'll be up to the administration. Our focus is going to be on advancing a reconciliation bill that supports American energy. That means new leases in the offshore, new leases onshore, reopening Alaska, which President Biden has taken a particularly focus on in terms of cutting off the amount of oil and gas that we can produce in the state of Alaska. So we're confident that we're going to be able to prevail on the administration and the Congress to advance new leasing priorities as they get that big new reconciliation bill done.
Have you heard, what have been, I guess, maybe any rumblings coming out of this new Trump administration about how aggressive they plan to be as it relates to oil and gas?
I think they plan to be very aggressive. I mean, as you know, the president has really focused on how do we continue to grow this tremendous American resource. We're producing about 13.4 million barrels of oil every single day, which is a record. We're producing records amounts of natural gas, but we also see record demand for these products. Not just record demand for oil and gas, but also record demand for coal and other sources as well. And that's because we're starting to see this the demand continue to increase. We're in a different era than we were during the first Trump administration, where energy demand was relatively stable during the first Trump administration. Everything's changed in the last 8 years, where you have new sources of demand growing. Data centers, of course, AI, more things being plugged into the electric grid. So I think what President Trump understands is that we're going to need a lot of energy going forward if we're going to win the energy security race.
Hey, Mike, it's always good to catch up. So many more things to talk about. We'll get you back. We'll go through them also. I'm like really questioning how we're going to get pipelines built. So next time we'll tackle that. Mike Summers, API President and CEO. And I should point out also the sponsor of Land Ban on Paramount Plus. Well, not Mike, but the API. That feels important to say. I just think it's going to be really interesting how it winds up evolving, and you need like all the things, and how do you get all the things,
Right.
and where does the money come for all the things, and what can you change policy-wise in a quick fashion. All right, coming up, Enda Kern will be joining us, Bloomberg Global Economy reporter. We'll talk about the U.S. blacklist of China's tech giants are rising even faster. Wow. Who's in the hot seat? How do we manage that? This is Bloomberg Intelligence. Happy Tuesday, everybody.
This is Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
All right, happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Just a flag for you guys, within the next, I don't know, let's call it half hour, President Trump and his team on the ground will be giving remarks at Mar-a-Lago. We're going to bring that to you live as it crosses. And speaking of D.C., in the meantime, we're seeing ramped up pressure on Chinese companies and their relationship to the U.S. There's a growing backlist of those Chinese tech giants, and it's happening pretty quickly. Enda Kern is Bloomberg Global Economy reporter. We got news about Tencent just in the last 24 hours. Where do we stand today versus where we stood like 6 months ago?
So it's another day, another series of companies being added to this list. As you mentioned, Alex, it's basically a list by the U.S. government that says these Chinese companies are working in collaboration with the Chinese military. And although it doesn't apply sanctions on those companies, it will make it awkward for U.S. companies to do business with them. And as you mentioned, we've had some new additions. Tencent, probably one of the best known internet companies in China, and best known for its apps and its gaming, for example. Not known to be in the military civil fusion space, but has been added to the list nonetheless. And some of the hawks in DC have been calling for that to happen. CATL, which makes the batteries for the big EV car makers, including Tesla, that's gone on the list with potential ramifications for the supply chain story there. There's also a shipping company, Costco, and some other big well-known Chinese companies as well. Now, of course, the Chinese authorities in Beijing have responded. They say they hope the US will undo this wrongdoing. And of course, we know China has options of retaliation of its own. They've been expanding their own kind of so-called entity lists as well. So it's just another example of the ongoing tensions between both and the tit for tat between both governments as well.
I mean, will the government undo this on January 20th?
Well, it's a tricky one because you would assume the incoming Trump administration are as hawkish as the Biden administration, if not more hawkish. You know, everyone's trying to out-hawk each other on China at the moment, Alex. So I don't know whether or not there will be a reversal. Obviously, there's a complication there with CATL being so critical to the Tesla supply chain. So that will be one worth keeping a close eye on. But broadly speaking, though, you'd have to say the direction of travel when it comes to export controls or investment restrictions, or potentially tariffs on goods made in China, coming from China into the US, and curbs on doing business and people flowing the like, that's all been going in one direction. So the Biden administration seems to be cementing its own hawkish legacy, putting its own stamp on this before they finish up. And it's kind of hard to imagine too much of this being unwound by the Trump administration.
So I guess then the obvious question is who's next? And I don't know if we know that, right? Like you mentioned Tencent, like that was kind of a surprise over the last 24 hours. But sector-wise, company-wise, market cap-wise, who do we think might be next?
Well, it is hard to say, Alex, because like you say, we've gone now from, you might say, maybe obvious companies who you could say are clearly aiding, or where the US doesn't want to aid China's technology aspirations, its chip aspirations, its AI aspirations, to companies that aren't necessarily in that space. So certainly it's been broadened now. That list looks like it's been broadened. So, you know, it could go anywhere from here. But the real question is, when the Trump administration comes in a couple of weeks' time, what will their initial focus be? Will it be on goods trade? Will they go hard with the tariffs, which the President-elect Trump has obviously spoken about so many times? Or will they get off to an early start also with ongoing investment restrictions, export controls, restrictions on technology and the like? And if it's that, then that's where we will see this list coming under more scrutiny again in terms of where they do go with it.
Any response from China in terms of how they retaliate in this particular kind of instance?
They had, well, the foreign ministry overnight did respond to say that, look, they obviously disagree with this. They want the US to undo it. They refer to it as wrongdoing. But we know that China does have options to retaliate. They've developed something of an entity list of their own, Alex, where they're putting US companies on their list, where they're making it harder to do business with Chinese companies, putting restrictions on the flow of, say, critical minerals, resources, that kind of thing that US companies might need. So China has options to respond where they are in this space. But there's also, though, there's also been some mixed mood music coming out of Beijing. They've been saying that when it comes to goods trade, at least, that, you know, they're open to listening. There could be some negotiation or deal to be done on that side of things. And I think that's why this China-US trade story is going to be very much an evolving one as the new administration gets up and running.
When you take a look then at how that does evolve, does China then wind up shipping more stuff to, say, other G7 countries, and then it winds up having this weird supply glut elsewhere, and then how that affects trade dynamics within the U.S.?
Yeah, the trade dynamics are definitely being upended at the moment. As you say, you know, even if China comes under tariffs or export controls or restrictions with the U.S., they either A, find new markets, to your point, or they shift some of that production over to third-party countries, and then from there they ship to the US and kind of skirt these controls. That's been an ongoing issue, and that's probably one that's going to come under scrutiny, I think, when the new administration comes in. And that's partly why some people think universal tariffs are being talked about this time around in terms of trying to make sure China doesn't come through those loopholes. So, you know, if you think back to the first Trump administration, those tariffs were kind of broad brush. They were continued by the Biden administration, but there's a feeling that this time they're going to have to be more surgical and make sure that those loopholes are closed.
All right, and always good to catch up. Thanks a lot, Enda Curran, Bloomberg Global Economy reporter, joining us there. Speaking of, 11 o'clock, I mean, we'll take bets on whether or not it actually is 11. We're going to have President-elect Trump remarks from Mar-a-Lago in Palm Beach, Florida, so we'll bring that to you. And then around 11:30, we'll have Jensen Huang of NVIDIA speaking to Ed Ludlow. We will also be updating you on those headlines as well. Also, I should point out that for our listeners in the U.S., this is a reminder for you. You can listen to us via satellite radio on Sirius XM channel 121. Do I say 121 or 121?
121.
121, that's what the radio kids do. Okay, access to the world's only global audio business network, coast to coast, 24 hours a day, Bloomberg Radio on Sirius XM at channel 121.
There you go.
All right, let's take a look at the markets here. We are just a little bit of choppiness today after the ISM services data. More coming up on Bloomberg Intelligence. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio, and we have an hour lined up for you. Within this hour, we hope that President-elect Trump will be speaking from Mar-a-Lago, Palm Beach, Florida. We will bring those remarks to you. Also, Bloomberg Technology co-host Ed Ludlow is in Vegas at CES, and he'll be speaking with NVIDIA CEO Jensen Huang. We'll also bring that to you as well. Lots of exciting things coming up. We also have some great insight from, say, Gina Martin-Adams, Bloomberg Intelligence Chief Equity Strategist. She'll give us her take on the markets for 2025. And also, we'll just touch back in on Canada. Canada had a big day yesterday in terms of the currency market and in terms of politics. We'll check back in with Brian Platt, Bloomberg Canadian reporter, as Canada's hit with inflation, and then you have Justin Trudeau resigning. But let's get you all caught up here with the business flash. And for that, we go to John Tucker.
All right, the major stock averages, Alex, right now, they are mixed. Bond yields are up, and the stock prices, as I say, they are mixed. Let's start off with the Dow Jones Industrial Average. Right now, it's turned higher, up 95 points, a rise of 0.2%. Best performing individual stocks in the Dow right now: Merck, Amgen, and Johnson & Johnson. Among the data behind the bond move today, pushing the yields higher, reports showing growth at U.S. service providers quickened in December. With a price measure, they are also hitting the highest since early 2023. Remember, services, that's the biggest part of the U.S. economy. BNY strategist Jeffrey Yu says, for investors, U.S. exceptionalism still does rule the day.
This is a unique growth paradigm that only the U.S. is capable of right now. You have steady inflation, perhaps upside inflation risk, which the central banks are acknowledging right now. Equities, due to innovation, due to productivity, still potentially generating the earnings growth that is not seen elsewhere. So if it ain't broke, don't fix it.
Right now, the 2-year yield up 2 basis points, 420, let's call it 430. 10-year up 5 basis points, that's at 468. And the 30-year, that's up close to 6 basis points. That is at 490. After hitting a record yesterday, NVIDIA giving up the gains today. NVIDIA shares right now, they are down close to 5%. Meta Platforms is going to end third-party fact-checking on all its social media platforms in the U.S., letting users comment on post accuracy. With a community notes system, it said will promote free expression.
Use air quotes on radio? Can you do that?
Air quotes on...
Also, Can you do air quotes with one finger? I thought it was 2.
Oh, I don't know.
It's 2? Okay, there we go.
No comment from me. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. Kind of red and green on the screen as John was just reporting. Let's look under the hood and see where the action is in the stock markets. Alexandra Semenova joins us. She covers all the equity markets for Bloomberg News. Alex, what are you looking at?
Hey guys, always great to join you. The first name I'm looking at is Getty Images. That stock is up about 27% right now, though it was up as much as 50% earlier into trading. This is after news that it will acquire its competitor Shutterstock to create a combined company worth about $3.7 billion. This is also a stock photo provider, and they're betting basically that by merging their operations, they can cut costs and boost profitability by offering kind of a wider suite of products. And what's interesting here is that the pairing will also be kind of a pulse on how the Trump administration, feels about mergers. Obviously, after the Biden administration blocked a lot of them.
Yeah, that would be really interesting as well. I wonder how many more competitors there are in that space.
I don't know.
Doesn't seem like
Well,
a lot.
here's the thing here. I was just reading up on this. You value an image like you would value any other asset. It has a value. But is that value going to be preserved in a world of AI, where AI can create any image?
I don't know.
Any image. So I don't know how. It would seem to me that the value of the existing images, whether it's a picture of whatever that we all know and love, would that go down in value if you could create?
Well, isn't that why they're maybe merging?
Have you ever seen Getty's library as some of the most iconic photographs?
I know, amazing.
All
So you
know.
still need them. So it's not like you don't need them, but you're talking about just like more stock stuff versus the iconic.
I don't know.
Well, now they have to compete with AI, so
Yeah, I think so.
perhaps they'll be more formidable
Maybe that's
together.
why they're getting you.
Speaking of AI, Uber is also up. I feel like this is an NVIDIA offshoot.
Yeah, so Uber actually pairing its gain from earlier the day. It's up only 0.5% right now. It was up as much as nearly 4% earlier into trading. It's teaming up with NVIDIA in order to accelerate the development of its autonomous driving technology. And this was announced, of course, at the CES event. NVIDIA is the star of that show. And basically, any name that they mention, investors are pouring money on it. I know Micron was also getting a boost earlier from their mention of a partnership. Any company working with NVIDIA basically is attracting investor attention.
Oh yeah, and that was interesting too. Just sort of the AI in a physical sense, like the utilization of that, and then it's Uber's tangible. All right, and then Moderna, how's that stock doing?
Yeah, that stock is really doing well, unfortunately, because flu cases are rising across the country. It's up nearly 13% right now, and other drug developers like CureVac are also extending gains right now because flu cases are on the rise, and investors are betting that their vaccines will be in demand during this flu season.
Okay, Moderna's had just a wild ride, but like the last 12 months, down 56%. Yeah. So it had that pandemic huge pop, and then
But that's probably when you're seeing all the flu cases rise, like that you're going to get ahead of it, right?
Yep.
And then you would play the rise, and then when the flu calms down, just like when COVID calmed down, then you sell. It feels like it's a tactical trade.
Just a parenthetical, because I did look it up. The most iconic images from Getty: the explosion of the Hindenburg in Lakewood, New Jersey, and the first flight of the Wright plane.
Oh,
Orville
that's
and
okay.
Wilbur.
But if you needed like generic stock photographs of like somebody
That I don't
shopping in Macy's or someone like mall footage,
You could do that too.
Would you need to go to Getty, or could you do an AI model?
When she writes a story about Macy's or whatever,
Yeah.
get one of those stock images.
But if it's AI, maybe you don't need Getty.
Yeah, soon enough we'll be typing whatever we want into an AI generator, and it'll be making images for us.
TV
already.
anchor, and then it'll be like an AI bot at the end of the day. All right, Alex, what else are you working on right now?
Yeah, just taking a look at, the broader markets. Obviously, we've seen a lot of back and forth trading kind of going into this year. There's not a lot of conviction compared to last year. Obviously, we're coming off of 2 consecutive years of returns of more than 20% for the S&P 500 index. That hasn't happened since the dot-com bubble, and investors are kind of wary right now. There's not a lot of conviction because they're awaiting more clarity on what policies Trump will put into place. We're waiting for earnings season. There's no clear catalyst right now. But something really interesting today, actually, a point that Bank of America made ahead of the jobs report Friday. They say we're going to go back to an environment where good news is bad news because rates are back on the rise. We're back above 4.5% on the 10-year yield. So we're kind of going to be perceiving strong economic data as a sign that the Fed will hold rates higher for longer.
Hold them higher for longer. All right, very good. Alex Semenova, she covers the equity markets for Bloomberg News. We appreciate her coming into our Bloomberg Interactive Brokers studio. Let's go to that equity market call. Her Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence, joins us here. Gina, again, 2 extraordinarily strong years for equity investors as measured by the S&P 500, north of 20% returns in each year. How did you and your team kind of frame out 2025 in terms of expectations?
Yeah, well, I mean, look, generally we look at every year independently. It's the last 2 years of returns were justified by a certain fundamental improvements that weren't expected. I think when we look at this year, one of the things that's very different from the last 2 years anyway is where expectations lie. At the start of 2023, as well as at the start of 2024, implied expectations for earnings growth in the S&P 500 were very grim. The general implied result expected by prices was less than 5% earnings growth in each year. We didn't get great earnings growth in 2023, but it certainly beat expectations. We got much better than expected earnings growth in 2024. Or at least it appears we did. We'll see when the fourth quarter results start rolling out as early as next week. What 2025 stands apart relative to those other 2 years is that expectations are now very high. So when we run through our models, the implied expectation for earnings growth this year is greater than 20% earnings growth to emerge. That's really difficult for companies to face down. And I think that could be pretty consequential to price action this year, which is likely subject to greater bouts of volatility as companies may not be able to surpass expectations quite so easily.
Right. So where does that struggle come in from? Is it big tech, Mag 7, or is it the other 493 stocks?
It's impossible to paint it with one big broad brush. It's a combination of both is the best answer that I can give you. A lot of it is indeed tech. When we isolate tech expectations specifically and we look at how extraordinary valuations are, it looks like the market is anticipating well north of 30% growth, maybe even as much as 40% growth in tech-specific earnings in 2025. That's a really tough bar to reach for tech companies at large. Granted, tech earnings are still growing faster than the rest of the index. They are decelerating from last year's pace, but nonetheless still solid, but still 40% is pretty unlikely and yet potentially implied by prices. That's not to say that there's not any risk in the rest of the index. However, there is an anticipation of recovery emerging in the rest of the index. We saw that with price appreciation last year, absent a tremendous amount of upward revision momentum in earnings expectations. So it's across the board in fits and starts, in pockets in the index, maybe highly concentrated in tech, but we can't be complacent and suggest it's only in tech. There is an anticipation of broad-based growth emerging in 2025, cyclical recovery emerging on account of monetary policy shifts that occurred last year, as well as an earnings cycle that is expected to continue to improve.
Gina, did you and your team in the days after the election alter your outlook for markets with this with the new administration and a new Congress?
No. And I think that, generally we run a very model-based approach. So we'll see if politics become policies in 2025. One thing that has been very consequential recently is what's happening at the Fed. We are seeing real-time movements likely in bond prices with respect to what's happening at the Fed. We are seeing real-time movements in what to expect on monetary policy going forward. The yield curve is very consequential to driving performance for certain segments of the equity market. So that's where we've been focused. A lot of our attention is if the monetary policy easing cycle is cut short relative to expectations, what that might mean for stocks. Now, will we see policies emerge in 2025 that are consequential? Potentially, but we're not in the practice of making a forecast to make a forecast to construct a portfolio. Instead, we utilize real-time components, drive those components through our models as they change, our portfolio strategies change.
Okay, let's go to the bond market then for a second on that. Do you think that where we're at is going to start to dent the equity market?
I think it already has.
Okay.
I think we saw stock prices struggle since the early part of December, reflecting what's happened with monetary policy. We've been in a process of consolidation since then. At that point in time, when it started to become clear that the Fed may backpedal from an easing cycle, we started to see stocks maybe not struggle tremendously, but definitely had a pretty tough December. And I think that was predominantly because of a monetary policy shift. I think there also might have been some pricing in November on sort of a post-election bump that proved a little bit of a false rally. We gave back a little bit of that in December, but I do think that monetary policy is already having consequential implications for equities, and we saw that emerge over the last several weeks.
All right, so given that background, Gina, what is screening well right now for you guys?
Yeah, it's really interesting because when we look across our spectrum of sector strategies as well as factor strategies as well as country strategies, a lot of consistency has emerged, and all of our models are pointing to slightly more defensive tone to start 2025. More healthcare-oriented equities, for instance, popped up in our sector scorecard for the U.S. Even with the potential for policy risks, healthcare is extremely discounted on valuations and has the brightest earnings growth prospects according to the analyst community. So that area, somewhat defensive, yet also has a degree of cyclicality to it, has popped in the sector scorecard. Low volatility is at the top of our factor scorecard. So the lowest volatility stocks still showing up as potentially very strongly positioned. And then when we look globally, we actually still see the U.S. as a defensive safe haven. But the U.S. doesn't screen particularly attractive on any of our metrics. It just simply is a defensive safe haven. When we look outside of the U.S., areas like Canada, Australia, even the emerging European, Middle East, and African securities, all segments of the market that have some degree of defensive qualification tend to be toward the top of our global scorecard. So most of our work is suggesting, at least in the short run here, move toward more cautionary kind of defensive plays in the equity market, reflecting an environment of slightly more elevated risk to start 2025.
What are low volatility stocks at this point when like one headline moves the markets?
Low vol is simply a factor classification. So low vol is going to be lower beta stocks by definition, and we rebalance our portfolio every month, every quarter to make sure that we're capturing who are truly the lowest volatility stocks in the index. It really is just a screen. We sector neutralize our low vol factor as well, so there's no true sector concentration, but it's going to be the truly lowest volatility stocks, those that respond least in downtrends, but also may have less upside in a super strong surge in the equity market, have performed quite well over the last year, and our work would suggest they continue to perform pretty well at the start of this year.
Gina, we've seen some reporting really over the last several months, maybe a little bit more, that international money is at an unusual rate has been coming into the U.S. equity markets. I know you talk to institutional investors around the world. Do you sense that as well?
Oh, yes. I spent the better part of November and December across Europe and Asia, visited 8 different countries over the course of those 2 months. And I can say without a doubt, the global investor is overly concentrated in the U.S. as a theme. And frankly, justifiably so. That's where the bulk of the return has come from. That's where the bulk of the optimism with respect to earnings has come from. The AI wave has been real. It's played out through fundamental improvements. But now we're at a point where that's where investors are entirely concentrated. This has upside and downside potential, right? Because if we see some sort of new trend emerge, we see some new opportunity emerge, we see some cyclical healing in the global economy, that could present a tremendous opportunity for segments outside of this area of risk concentration. But it also is a risk to global equity markets because it puts the onus of expectations on this single theme, this single sector, this one big driver of opportunity. Now, it's not overwhelmingly the only thing that investors are buying right now. They certainly have bought the broad market, but certainly there is a degree of concentration risk that we want to be wary of and track pretty closely.
All right, Gina, super appreciate it. Thank you so much. Gina Martin Adams, Bloomberg Intelligence, Chief Equity Strategist, joining us there. Also, like, foreigners own a ton of our bonds, too, so there's like a very heavy U.S. exposure. All right, coming up, we're just moments away from Jensen Huang and his interview with technology co-host Ed Ludlow from CES in Las Vegas. That's going to be quite interesting. We'll also go back up to Canada and talk to Brian Platt, Bloomberg Canadian reporter, on the tilting right of Canadian politics and sort of what happens next. You are listening to Bloomberg Intelligence on Bloomberg Radio. Also catch us on YouTube. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, the offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Well, better than expected reports on the job market and business activity have sent Treasury yields higher, and the major stock averages right now, they are mixed to little change. Particularly sensitive to higher rates, that's technology, because generally you're paying for future growth with technology. So the tech-heavy NASDAQ down right now just under 1%. And after a record close yesterday, today shares of NVIDIA giving up those gains. Shares of NVIDIA right now down 4.9%. Overall, the S&P 500, 27 points lower. That's down 0.5%. 59.48 on the index. The Dow Jones Industrial Average up right now about 10 points. The NASDAQ 100, 220 points lower. Again, that's down 1%. The 10-year yield up 6 basis points, 4.69. 2-year up 3 basis points, and that is at 4.30. Whirlpool implementing cost-cutting measures to increase profit margins on their washing machines, Paul. Whirlpool is stripping a coat of color, leaving some internal parts unpainted, and removing unnecessary parts. What counts as an unnecessary part on a washing machine? New washing machines, despite all this, priced $100 higher than previous models. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. You can always go on Amazon and find the part that you need.
You can find anything on Amazon, right?
Take apart your dishwasher, your clothes washer, and fix it.
I have people for that.
I do it for a small fee.
Yeah, I'll get you a cocktail of every choice. John Tucker, thank you so much. We appreciate that. John Tucker with our update right there. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Well, big day yesterday for our friends in Canada as Justin Trudeau's resignation throws Canada into political turmoil. At least one thing seems certain: an economy centered on record immigration, expanded government spending, and green ambitions is set for dramatic reshaping. To bring us to the latest details, Brian Platt, government reporter, Bloomberg News. He is in our Ottawa, Canada studio. Brian, with a little bit of hindsight here, what happened yesterday to Justin Trudeau? How did we get here?
Well, you know, I've covered Trudeau for a long time now, and his party's been down in the polls for actually almost 2 years, and there was a lot of pressure on him last year to step down and give his party time to get a new leader, but he did not want to do that. He was absolutely determined to lead his party into the next election. The next election was going to happen sometime in 2025, potentially as late as October, but 3 weeks ago, his finance minister, Chrystia Freeland, resigned. It didn't just quit. She really took him down with her. She criticized him pretty fiercely on her way out. And his party turned against him and forced his hand. And so, you know, he spent the holidays to think about it. But his resignation yesterday, he had tried to avoid this. He did not want to do it. But basically, he had his hand forced by his party, was not willing to support him anymore.
What's next here for Canada?
Well, now we got quite an interesting few weeks and months ahead because the opposition parties want to have an election right away. And we have a parliamentary system here where Trudeau does not control a majority of the seats in parliament. So they can force an election if they vote against him on a key bill, such as a budget bill or something like that. That looks like it's going to happen in late March. So you basically have 2 months and a bit to find a new leader, and that's a much faster timeline.
Right. All right, Brian, we're going to have to leave it there. President Trump is coming, and I'll have some comments right now. So let's head down to Mar-a-Lago in Florida. President-elect Donald Trump.
Things are happening that are exciting, very exciting for our country. And we're honored to welcome one of the most respected business leaders in the Middle East, indeed the world. He's a founder and chairman of Damac Properties, Hussein Sajwani, very respected gentleman. And I'm thrilled to announce today that Damac will be investing at least $20 billion over a very short period of time into the United States, and they may go double or even somewhat more than double that amount of money. It's a great thing, and I believe he will say that he's doing it because of the fact that he was very inspired by the election. They wouldn't do it without that election, I can tell you. A lot of people wouldn't. You saw last week where we have somebody who's going to go from $100 to $200 billion, and we have many other people, and we'll be bringing some of them out. Some of them like to do it somewhat more quietly, and some don't, and they feel so strongly about the country that they want to let people know about it. But it's an honor to have such a great investor investing in our country. The investment will support massive new data centers across the Midwest, the Sun Belt area, and also to keep America on the cutting edge of technology and artificial intelligence. He's very big into the data centers, and that's going to be a very hot item in the coming years, as you know, with AI. In particular, the first phase of the project will be in Texas, Arizona, Oklahoma, Louisiana, Ohio, Illinois, Michigan, and Indiana, those places. And Hussein, I'd love you to come up and say a few words. Thank you very much. Thank you. Thank you.
Thank you, Mr. President. It's been amazing news for me and my family when he was elected in November. We've been waiting 4 years to increase our investments in U.S. to a very large amount of money. We are a company operating in more than 20 countries around the world. We have delivered more than 45,000 luxury units and another 45,000 in the pipeline. In data center, we are in 10 countries around the world, in Asia, Europe, and Middle East. And we're very, very excited now with his leadership and his open strategy and policy to encourage businesses to come to U.S. For the last 4 years, we've been waiting for this moment. And we're planning to invest $20 billion and even more than that if the opportunity in the market allow us. But at the moment, we're planning $20 billion in data center, catering for the AI and cloud business for the hyperscalers.
Fantastic.
Thank you, Mr.
Great
President.
honor. Thank you very much. So nice. And that man knows what he's doing. He knows. So, Hussein, we're going to work with you and make sure everything goes smoothly. We have powers that haven't really been used in terms of environmental. If you invest over $1 billion in the United States, we're going to give expedited reviews to everybody because everyone's afraid they're going to come in and get caught in the quagmire, which is very prevalent in the United States, unfortunately, the quagmire of environmental and various other regulations and rules. And I made it a point of telling people if you invest $1 billion or more, and we'll do this for people with far less too, but we guarantee it. We're going to move them quickly through the environmental process. Sometimes people held up 12, 13, 14, 15 years. I saw it with plants in Louisiana where I got it approved in literally a week. They were through the review in 1 week.